Right. So let's start the next part, guys. The next module, which is derivatives. Okay. I hope many of you all know the concept of what exactly is derivatives and what it means. We'll cover derivative instruments, look at what the derivative market has, the features, commitments in the derivative market, and obviously how it's used to benefit the users and how does it help to mitigate the risk. Okay. Now, before we really go to that, let's understand what exactly is a derivative. Now, a derivative is basically any security, okay, any instrument where the instrument is deriving the value, okay, the security instrument is deriving the value from another instrument, which is also called as underlying. Okay. So because that instrument is deriving the value from another instrument, therefore it is called a derivative. Derivative. It is deriving value from another instrument. Here. Okay. Now, quick example. Let's say, how do I explain that to you? Let's say I took a Reliance shares, a Reliance share cup future. Futures is a derivative, right? The future is on Reliance shares, right? And also this futures is, let's say, worth around 1500 because the value of Reliance is also around 1500. So the futures value is 1500 something. Now, if the Reliance shares goes up, then this future, which is a derivative contract, even this value will go up because this contract is dependent on the underlying share. So as this value goes up, this value goes up, this value is derived from this value. So therefore, this is called a derivative of line shares. So I could take derivative of any share. I could take a derivative of futures of anything, forces, TCS. Obviously, whatever the underlying, that underlying might go up or down. This futures contract will also go up or down based on the underlying, right? What could the underlying be? Underlying could be anything. It can be even something abstract as the weather. If the rain comes, the value will go up. If the rain doesn't come, goes down. It can be anything. The underlying would normally be stocks, interest rate. Interest rate going up, the value of the contract will go up. The interest rate happen. Thank you. Okay. So the underlying could be equities, it could be shares, it could be indices also. I could take a derivative of the Nifty. The Nifty index going up or down. The bonds, it could be bond indices, it could be interest rates also. It could be commodities also. I could say onions, tomatoes. It could be metals, gold, silver. I could have derivatives on that price. Silver price goes up, the future value. The futures contract depends on the value of the gold and silver, right? All of you are seeing the gold silver crash and happen in the last 2 days. Because the value is going down, the future contract also of the gold and silver is going down because the contract is deriving the value from the underlying instrument. Okay. Credit indices, all of these are the part of your derivative. And these are all the examples of underlying on which I can buy a derivative contract. So underlying can be interest rate future, equity future, bond future, and so on. Clear the concept of what exactly is derivative? Now, in in the real world, there are many types of derivatives, but from a CFA exam point of view, to understand and to solve, we'll mainly focus on four types: forwards, futures, swaps, and options. Bus. This is where you have to learn the mechanism, the solving, maybe of interpretation. And there's a fifth one, which is called credit derivatives, where we'll only understand the concept of credit derivatives, where's the underlying risk, and where they derive the value from. But from a sums point of view, you'll have to understand forwards, futures, swaps, and options. So broadly, the other types of derivative, right? Now, a derivative could be of two nature. Okay, it could be a derivative that is traded over the counter, means over the counter. Counter hai, you're the seller, I'm the buyer, or I'm the seller. I'm giving you over the counter, you take the money. So over the counters, as you're saying, to dukaan pe ja rahe, going to a shop and buying something, that is called over the counter. Obviously, if you're going over the counter and trying to negotiate and buy something across the counter, you will be able to customize it. You'll be able to deal with the person directly, right? You'll be paying him cash and taking the goods. You'll not say, chalo, difference we manage, right? Obviously, the liquidity is very low, and it is possible that suppose you enter a contract to do something future, that guy may disappear on the day of settlement. So the counterparty risk is very, very, very high, right? You're dealing in the dealer's market, obviously, and over the counter is normally not regulated. Who will sit and bother to किसको मिल रहा है, किसके साथ deal कर रहा है? They'll not regulate on that because over the counter, correct? And you cannot deal with a third person. You're dealing with him, you close with the deal with him. There's no other secondary market here, right? Which instruments trade over the counter? Very limited, guys. Normally customized, so exotic instruments which are meeting your needs. Swaps, forwards. Forward contract are normally over the counter because normally this is always looking at cash settlement. So जो भी cash में settle होगा, normally is traded over the counter, right? Even swaps, interest rate swaps, you'll have two people who want to enter a swap, but they have to have someone who's in the middle called a banker. So swaps are also done through two people over the counter and not through the exchange. Clear? Now, if I don't want to do over the counter, I can simply go to the exchange and just look at what's available and just buy and sell whichever I want. So I could go into a Reliance future on the exchange, see what's available, buy it. Here you cannot sit and customize. Here you can only take what is available. So in an exchange traded platform, I will see what's available and standardize contracts. The exchange is the counterparty. I don't know who it got sold to. I bought it. I don't know the seller. To me, the exchange is the seller. To the other guy, the exchange is the buyer. Right? Obviously, if I'm doing through exchange, the exchange says, boss, every date will say mark to market. So obviously, there's very high liquidity, but the exchange involved, and therefore there is no risk at all because mera counterparty exchange it. Correct? It's centralized, obviously, it's highly regulated, and they normally have an active secondary market. The most popular ones are futures and options, which we'll cover. Clear? So please, guys, look at this carefully and understand what's the key difference between exchange traded contracts and over the counter. Take a minute, guys. Any doubts you have on these concepts? ETC and OTC. What would you like to trade? Obviously, the standard answer, everyone should go for ETC because there's no risk, there's exchange traded and so on. But if you do want to go for something that's not standard, that's something more customized you want to do, then you please do the over the counter, but do not do it directly. Try to involve a middleman, like a banker or a broker, someone who will make sure that the deal is not mistaken, is not affected, it will go through. So try to keep a middleman involved to the extent possible. Here, okay. So that's your OTC and ETC. Right? Quickly, we're not done with this. We just go to main parts. So that's your derivatives contract, derivatives markets, which are following most accurately describe the derivative security, which most closely describes. Does it always increase rate risk? No, it is mitigating risk, right? It's affecting. Does it have no expiration date? No. Every derivative will expire either after 1 month or 2 months or 3 months. Does it have a payoff based on an asset? Yes, it's always deriving its value from another asset and therefore it's called a derivative. Yeah? Which are following is least accurate. Least. So you have to tell me which is accurate first, then you eliminate that and give least accurate. Is exchange contracts liquid? Yes, it can be bought and sold. Are they standardized or customized? They are standardized, not customized. Do they carry significant default risk? No, because they are traded through the exchange And therefore, this is the right answer because that answer is the least accurate answer. Clear? Okay? Least accurate. Okay? Now, let's quickly look at how the commitments work and what are the features for that. Please understand what the institute expects you guys to know and learn. The learning outcomes is defining what forward contracts are, future contracts, swaps. Now, like I told you, they will mainly make you understand these four very well and obviously know what exactly you mean by credit derivatives and be able to compare and contrast them. Then they'll ask you sums around valuation from call and put options, how to profit from them, what is the value, what's the profit and loss, and so on. And then we look at the how forward commitments are different from contingent claims. Okay, quickly, what's a forward contract? Now, a forward contract essentially means anything that is contracted for a future commitment, right? When two parties come and say, boss, I want to enter the forward contract. The two parties come together and they commit. What they commit, one will buy, one will sell. They'll deal with one asset at a future date, at a future price. So let's say A and B come together. A will say, I want to buy. B will say, fine, I will sell. What? Let's say Reliance, 100 shares at 1500. So A is telling I will buy Reliance shares 100 at 1500. B will say I'm selling you Reliance shares at 1500. So A will have to pay how much? 1,50,000 and B will have to sell Reliance shares. This is a commitment. Now the Reliance shares becomes 1,600, 700 or 2,000. He cannot say, oh sorry, I'm going to back out. He has to sell the shares at 1,500 no matter what. Same funda, if Reliance becomes 1,400 or 1,000 bucks, this guy will make money. But he can't say, no, sorry, I don't know, it's too much. No, he can't do that. He has to buy and he has to sell, and the commitment cannot be backed out. And that is a forward contract. No commitment, no can be broken. Best example of forward contract is farmers, onions, right? A farmer has got crops. Let's say he's got onions. Let's say he's going to cut 100 kg onions from his land. Now he doesn't know that market may boss, my onions will be selling for 80 or 90 or maybe 120. I mean, market price will be 120. But what if 120? He said, okay, good, I'll get 12,000 rupees. I'm happy. But what if 120 per kg for 100 kg becomes 90? Or market he doesn't get 90 or that much. He gets 90. So he which lost 3,000 rupees or 80. He lost 4,000. So in order to secure this price, he will go and say, boss, forward contract में मुझे 120 का contract दे दो मुझे. So now he'll hold the other partner to commit that you will take mine at 120, even if the market fails or collapses in the future, you will still take it at the amount of 120. Clear? Okay. So this is critical. You have to stay committed no matter what, and you can be buyer, seller. Now remember guys, buy means is long. Sell means short. So I may have a long forward or a short forward. Here, unlike asset, it's at a future date and future price, and both. So future data is certain, future price also certain, but the actual price will never be known in the market, right? So forwards, they're customized, they're always subject to risk. Remember, dealing with a person directly, he may disappear. It's difficult to close out. They carry low liquidity, and they're used by hedgers to ignore the options. Clear? So normally forwards are not speculative. The person with a forward contract is very clear that he wants to mitigate his loss. So it's normally not a speculative contract. It's a contract to close out his position, hold the position, and close it out on maturity. Yeah. Other contracts we can close it whenever you want. So a person who wants to hold will go forward. A person who wants to decide, I shall decide when to hold, when to remove, he should go for future contract. Clear? Any questions? Yeah. Let's look at a quick example of a forward contract. Okay. An investor enters into a cash settled forward contract to buy 100 ounces of gold. So the amount is fixed. The forward price also is fixed. He's going to buy it at 1,792 per ounce. The time period also is fixed. So quantity is fixed, rate is fixed, and the time period. Today's price is so much, right? So obviously he's going to buy at a higher price because obviously he knows the price will go up. So he agreed to buy only $22 more. Fair enough. But when he went to actually buy on maturity, what happened? The gold price went up only by $10, right? Right or wrong? So you have a forward contract for so much, this so much. You have an actual price for so much. They are saying find the forward price. What's the forward price in this equation? What's the forward price? Easy to note. Is exactly what we have potentially picked up, right? 1792, spot price 1770, contract maturity is 1780, right? After 3 months. So effectively, how much is the amount that he's going to pay off or rather settle for, right? Now, if you look at this quickly show the example, right? Today it's 1780, today it's 1770, but honestly, this is pretty much useless. I don't need it. In the future, I agree to buy it at 1790, 92. But the price on the date the contract ended is 1780.50. Correct? So when I agree to buy 792 and it's actually 1780, that means I have a loss of 11.5 per ounce. Correct? The gold price, what you agree to buy, you're paying more. You agree to buy it at 1792, but the price is only 780. So you have a loss which you're going to pay of $11.5. But don't forget only 100 ounces. So it's the amount that you're going to incur as a loss is 11.5 per ounce into 100, which is 115. Clear the logic? So you remember this is useless. You agreed at this price. The price is actually so much. The difference is what you are responsible to pay, or you pay the full money and pay the full amount. But this is the amount of loss that you have to incur today by way of doing the contract. Yeah. 1792, 1780, and therefore you end up with a loss of so much based on the 11.60. Clear? Now, let's see. Let me make you guys do an exercise. I want all of you to match the number, match the following. Start. What is the forward contract purchaser seek to know? He purchased the forward contract, right? So he's long. He went long. What are you doing? He's trying to seek benefit from underlying price depreciation? No. He's buying. So he's trying to benefit from appreciation, right? He will gain the initial spot price is more, or he receive a positive damage of spot price exceeds the forward price. So he agreed to purchase at a certain forward price. If the spot price goes up, he agreed for cheap, right? So he will surely get a positive payoff if he has agreed for a cheaper price. Yeah. For that to happen, the spot price should go up. Okay. Who is the forward contract seller? What does he do? Now, obviously, your purchaser is trying to benefit from an appreciation. A seller will try to, okay. Now, you are given the initial spot price exceeds the forward price. Seeks for underlying price depreciation. What's the answer? Either forward. Clear? Okay. Purchaser wants appreciation and therefore he will earn maturity. Seller wants depreciation and therefore he will earn a maturity if the price he sold at actually falls in the market, he has the right to sell at a higher price, right? Neither a forward purchaser nor seller will realize any gain if the initial spot price is exceeding. तो उसको फर्क ही नहीं पड़ेगा, right? Because he will not earn anything on day 1. He will earn on day 30 or day 60 or day 90. So remember guys, these guys have 0. On day 0, effectively, he'll have nothing. On day 0. No profit, no loss. You got the concept? Answer the markings carefully. Any doubts? No doubts? Okay.
Sir, can you explain part C?
So part C, so basically you're saying, see, now neither forward nor purchase nor seller is fine. Now, if you correct this, realize the gain if the initial spot price exceeds the forward price. Now, when you enter into a forward contract on day 0, right, you are obviously going to enter into a forward contract where the forward price is going to be either greater than or it might be less than the spot price. It's going to be, right? That's in your forward contract. So just because the price is greater than less than, it does not mean that you will realize a gain or loss. There is no gain or no loss on the date of the contract. That's why I'm saying neither of them will make a gain or loss on the date of the contract. Here, on the contract date, no profit, no loss. On the maturity date, they will book their profit or loss by looking at the market price. Got it? So today there's no point looking at this price. It's only on the date of maturity when the stock price is out. Clear? No questions? Any more? Understood that answer? Right? Mention that. Now, suppose you can put, like I already told you before, that the person who's buying is called long, the person who's selling is called short. So in the exam, they may tell you, they won't say buy or sell, they say long and short. So तुझे जाना चाहिए long खरीद रहा है, short बेच रहा है. Who is a forward contract? Someone who has a risk, not someone who's going to take a risk. Risk ले लिया, अभी बोले अभी मिटके में कैसे करूँ? अच्छा, forward करेंगे. How to get the benefit future contracts? So they're taking a risk and then they mitigate it. Okay, and I told you sometimes you do one-to-one or sometimes you offer middlemen or dealers. What are the dealers? All the JP Morgan, Morgan Stanleys, things like that, right? All the dealers are going to sit and create a fund around it and then get. Clear? So remember the long wants to hedge against an appreciation. तो पहले slide में देखा. The short wants to hedge against the price depreciation. Which are here, long and short. Okay. So cash proportions taken, very important to make sure that you understand those portions. Now, so far we've done only forward contract. We said commitment hai, karna hi hai, you have to give the goods, pay them, take the cash and so on. Now it is possible that instead of sitting and saying, boss, you pay me full cash, I'll pay you shares. You can simply decide to do it based on net settlement. Net settlement. You can see how much the market price is here and put it. For the net settlement is when you are settling it in cash. That is exactly what a futures contract does. They will settle the amount in cash by looking at the differential. That's it. Okay. So obviously future contracts, you know, they're standardized, right? They're all standardized contracts for the future. Defined amount, defined period, defined rates, and so on. Right? They're backed by a clearinghouse, obviously. Okay. Obviously, they're backed by the clearinghouse. Make sure that these contracts are settled, are cleared, are not cleared, are written off, and so on. Okay. Election at the clearinghouse, it can be treated on others, and that's that. Okay. So here I'm talking about futures where there is absolutely no leeway. They will settle it mostly in cash because that's what futures are for. Okay. Now let's look at this example. Right. So are we clear futures also now? Forwards, futures, right? Now we'll apply the same concepts that we did in the earlier part. We'll try to value something by looking at broadly zero arbitrage, right? Now you know future contract on the day one is going to be value at market price. So हो ही नहीं सकता, so they'll have no value on day one because the entire amount is considered in that aspect valuation. Future contracts are marked daily, so रोज का profit loss, रोज का will be given to them or reduced from them. So they keep accruing that every day, right? The value of future contract values is zero only during the trading hours between the times at which the account is marked to market. So when you're marked to market, obviously say, oh, मेरे पास value है 100 का, but market is showing 120, right? I'm losing 20 maybe, so I will put 20 and market that. Yeah, mark to market. Now, what is the value of future contract? Very simple. What's the current year's price? Future's price minus the 2. Yeah. Broad answer to the value. If the future price increases, the value of long increases. Obviously, we know that. So, if future price बढ़ा, so value बढ़ेगा. My mark to market will also go up. If the future price decreases, then long will suffer and short will benefit. Yeah. So please learn the valuation well, because in valuation I'm looking at applying current future price, right, minus the previous market price. Yeah. Any questions? So future contract is more valuable and it's based on the amount of time left and the uncertainty because of which the value may go up. Clear? So quick recap between forwards and futures. Very important. Please learn this very well. Forwards are not regulated or limited, but futures are properly regulated. Exchange traded, OTC, ETC, OTC, right? Default risk is there, you're not there. Margin is not required in forward because there's no mark to market. So remember, mark to market has happened, then there's no need of it. Oh, they didn't mention that. There's no mark to market. अगर मार्क टू मार्केट होता ही नहीं है तो मार्जिन भी नहीं चाहिए और डिफॉल्ट भी हो सकता है, राइट? यहाँ पे देयर इज अ मार्क टू मार्केट मॉडल. If mark to market happens, that means I'm guaranteed margin, standard, and so on. Clear? This is my mark to market model. And the others are obviously that you know, example, default risk, credit risk, so the other aspects are the same. Okay. That is my main difference between forward and future. Now, let's come to the second main difference between a forward and a future. Main difference. In a future, you are supposed to give a initial margin. So let's say I entered into a, let's give a different example, let's say Infi future, right? Now, remember, you always get a certain number of shares. So let's say I did 100 shares. And the value of Infosys is how much? Let's say 1600. Okay. So that means you are going to receive, right, the amount if it goes up or if it goes down. Correct. So right now, dealing the price of 16,000. Correct. Now, remember, the value that you agree to buy it at is 16,000. You will have to put some down payment today because you may disappear. Even this guy. So you need to put down a down payment, both him and this guy, which will allow, okay, the down payment will allow the trade to be executed. And here you're paying nothing but initial margin. So let's say I'm putting a margin of, let's say, 500. Okay. Now 16. Here. Infosys. So 1600 means 1.6 lakhs per year, right? Now I am saying that I have 500 for Infosys, right? I'm also saying I have certain number of shares. So as I keep increasing, I need to put a certain margin that will take care of this amount. So my margin might, for all you know, might be 20,000, right? If I put the margin, whatever profit loss is there will be adjusted from margin. This margin is called initial margin. Okay. Initial margin Q, because this margin is to protect 6 lakhs and this margin we utilize for all the losses. Let's say 20,000 ka tune 50,000 book kiya, right? Or 120 book kar diya. Okay. Then if the margin falls, let's say margin became now 8,000. because you book losses. Then they'll say, boss, I want you to give me more margin, and that is called variation margin. Means I'm varying my margin amount to a higher amount. But this you will do only when the margin falls below the minimum maintenance. Matlab so you maintain 9,000. You are supposed to maintain 9,000, you didn't maintain. Correct? That is called maintenance margin. Maintenance margin. Clear? And maintain margin nothing but the amount you maintain. Below that it goes, it will trigger a call which is called as variation margin. Clear? Okay. Now see, that's this formula, variation margin. Whenever you're called upon to make a payment to this, you have to actually consider having the variation margin. Okay. Any questions on this? Good points. Okay. Future prices and of the spot price, this is exactly similar to earlier module. There is a future price equals spot price, but if it's including interest rate, it will work out. Okay, spot price is always a reflection of the spot market price and where it might be the future, right? Now the futures price will always converge to spot price. It will converge because the price is also smaller. Okay, and at expiration, the settlement price equals spot price. At expiration, say, boss, okay, now agreed. Now let's come to the agreed price. This agreed price and settlement price also refer to as spot price. So you are going to effectively look at my agreed price, market price, combine the two, and then decide which is higher and based on that. Clear? So you remember settlement price, spot price. Very good. You saying something? Understood? Okay. So settlement price, spot price, futures price, and finally expiration price. Clear? Now what exactly is market? I already tried to explain to you. For example, let's say I work contract for 2.5 and the contract price goes about 2.5, then it's called limit up. मतलब limit के बाहर गया, limit के ऊपर गया तो limit up, limit के नीचे गया तो limit down. So I do have stuff based on that, but I need to look at what's the amount involved. They're saying no trade will take place. Okay, because lock limit. Obviously, if the limit go lock ho gaya, so you can't do much. Correct? They say can't be taking place. And the exchange imposes price limits within which you can do it. So you have to ensure that your price is somewhere more than this and this than this. Yeah. Okay, now you come to the part where this is called mark to market. I'm trying to mark my position on a daily basis and pay that amount. Okay, mark to market. Now we have done the earlier example, same way they're showing this, that if you enter in futures for 1792 and the market price is 7080 on expiry, how will you deal with it? Obviously, you have to ensure that you have picked up the right number and values. Okay, program is paying so much. See, margin account is 5,450. Okay, so don't worry, you may not find a perfect mix between the two always, but you have to have some mix and relationship. Okay, it's an interesting one to show you how mark to market happens. Now, when I say mark to market, this is my daily gains or loss, Rojka. Okay, and that's my margin balance. I have decided that at this price, I will be able to consider that 1792. Any questions? So this is what I agreed effectively, and based on this, I have maintained a balance so much. Now later, this guy says it's increased, right? So he has to now pay more amount here, correct? Later it further increases, decreases. So therefore, much more amounts here, correct? Then 82, 37, 79. So this is gradually going down, right? But then these two are finding out certain variable needs, right? So you see the total gain or loss is not important. The margin balance, you started with 4950, it increased, then it decreased further. You are allowed to consider, based on that. And also the margin call. See now, your margin should have been around so much, it went much lower for first time. So therefore the answers are good. Okay. Take your time, guys. Shall we want to swap now? Now, in a swap, right, you're swapping the two instruments, right? This is nothing but we're trying to swap your amount or rate or other benefit to someone else who will be more than willing to use them accordingly. Yeah. Okay. So this obviously is when you're getting periodic payments. Quick example. Let's say is earning A earns 7% on FD and B wants 7%. Okay. He's saying, boss, give me 7%. He is willing to give a fixed rate. And this guy बेचारा wants fixed rate. He said, ठीक है, एक काम करते हैं, you pay me. Okay. Fixed rate. So A and B will enter into a swap and say, let me give you my rate, you give me your rate. So what he is already earning and what he is already paying, they will swap the two and effectively A will tell B, भाई तू मेरे बेhalf पे collect कर लेना, and B will say ठीक है मेरा भी तूने मेरे behalf पे payment. Yeah. So these are instruments. Obviously, if you customize instruments, you can get a series of formulas. Yeah. Okay. So this is just a bit of theory. Okay, but in a swap, remember, there will be periodic payments. There will not be a one-time swap. You'll have to swap it over the period and then give them the payment history. Yeah. Okay. Now in swaps, we normally have the most popular one is called the plain vanilla interest rate swap. Now the plain vanilla interest swap basically refers to a simple plain interest rate swap जहाँ पे interest is being swapped every quarter or every period, right? Now look at the example here. This swap है. I've agreed to swap my floating rate for fixed rate, right? Floating rate to a fixed rate. That's called a swap. Okay. Now here they're saying for 6 months. Here is 5 years, but the amount is 200 million pounds. Here. So here I'm actually doing a swap where, see, look at this, 180 means after 6 months, after 1 year, after 270 days. So here I'm not even clear, sure what exactly is happening on the inside. Okay? And you notice that because that's fixed, they are divided by 2. But you don't have much of a choice. Yeah? So this is a plain vanilla interest rate. So please understand, guys, the principal amount does not change money. I am saying my reference point is 200 million pounds. I will pay interest on 200 million, you pay me interest on 200 million, but I will not allow him or me to touch the underlying book. That's more critical. Yeah? That's how you take the risk. Okay? When I deal interest rate, obviously remember it is always normally by 2, but you have to be careful about the patterns. Okay? Now you guys take a minute if you understood and we'll do it properly. Take a minute to answer, take your time and answer which of these, how the interest swap goes and what is the amount of cash flow that will exchange every quarter. So no, every quarter we're going to affect the cash flow, right? Every quarter, how much is the amount that we received and paid? Answer, take your time, draw the timeline. For the sake fire contract, receiving $200 million interest rate. Receive fixed 200 million interest is for the financial indicator to increase the duration. Under term swap, by Filton has agreed to receive a fixed rate of 2.5 and pay MRR of whatever. Now remember the MRR is a rate. It's not given. अगर दिया ही नहीं तो तुम उसको पैदा नहीं कर सकते. You have to do it based on what's given to the exam. They'll tell you later that MRR is fixed for 1.9%, right? So that's one more broadly. Okay, MRR is the rate. So you have to find out what is the cash flow hedge for the exchange year, and then based on it, we're going to follow. Right, 5-year fixed with the intermediaries. Now they're telling you that for the first swap, I'm giving you the information. Exchange is 1.95. So तुझे पता चला यार 1.95 था, and how much are you trying to do? You're saying I want to receive 2.25 and I'll pay. So You are going to receive 2.25 and you're going to pay how much? 6 month MRR 1.95. Correct? Okay. So obviously this guy will receive 1.95, right? He'll receive based on that and he'll pay the other amount. Okay. Now, what is a cash flow? Swap cash flow exchange. Simple. Find out that after 6 months, how much is that he has to receive and pay based on the details. Okay. So I told you cash flow is set for 1.95. So go on. Who do you think will be the answer for this? Answer? So here I'm paying 6 months. Okay, every 6 months. So what's the flow in that? Okay, go on, start. So here you have the concept of financial intermediary, where you owes some amount to the people, and he owes a financial intermediary also some amount, and the banks are all fine. Okay. So you have to ensure that the cash flow is not impacted and the cash flow is continuously coming to the top. Okay, fine. Okay. So this is interest rate swap. You have to understand interest rate swap. Which one is being swapped? Here the interest rates are being swapped. So therefore the amount as per the books are also different. Here, so interest rate swaps, I'm swapping, and remember it normally happens every 3 months because interest rate is set back every 3 months, right? Now, using interest rate swap, you guys think what is the answer? Using concept interest rate swap. Now remember in the interest rate swap, we have a fixed rate and a floating rate. One person will pay fixed and receive floating. The other person will pay floating and receive fixed. So what does fixed rate payer do? Does he make a payment based on market interest rate? Market interest rate is floating rate. Who will pay market interest rate? The floating rate. Who will pay a fixed rate? May face a positive to negative mark to market over the life of an interest. Both. Now we have fixed rate and floating. You know there are two pairs. One is paying fixed and one other is paying floating, receiving fixed. One is paying fixed rate, right, and receiving floating, and the other fellow is paying the floating rate and receiving fixed. So both of them, is it may face a positive negative mark to market over the life of an interest rate swap contract, or do they receive a net payment on the swap for any interest period for the market reference rate exceeds the fixed rate? So here I'm saying the market rate exceeds the fixed rate. Market rate is greater than the fixed rate. So if he's right, and he's saying receives a net payment on the swap for which the market reference rate is greater. So when we receive a net payment, when he's paying a fixed rate and the market rate is greater, then he'll receive a what? Of net payment. So fixed rate payment guy will make money when the market rate is higher. Correct? And therefore both of them may face a positive and negative mark to market over the life. Clear? Okay. So fixed rate will benefit from the market rate going higher. Floating rate will benefit from the market rate basically going lower. All right. Any questions? Here, these are good examples of match the columns, but very good illustrations that way. Yeah. Good. You got the answers right. Well done. Okay. And now we've done futures. We've done forwards. We've done interest rate swaps. Now we'll come to options. Options is a beast. There's a lot to do in options. Clear? Let's come to it. Let's just quickly, quick 5 minutes. Now we're going to just have a cup of water. Use the washroom. Now more than 3-4 minutes. Let's reconvene and we'll start options. Right. So let's start options. Okay. Now options is very different from forwards, futures, and even swaps, right? That's why I wanted to make sure that we do this separately and you understand the key difference and understand the terminologies here. That's very important. Okay. Now let's start with the main concept, option. Now in an option, like in a forward or future, you have no choice. You have to go ahead with the price. If I decide that I have to buy Reliance at 1500 after 3 months, I have to buy at 1500. I don't have a choice to back out. I cannot back out from the deal. But in an option contract, you have the right to back out of the deal. If you buy an option to buy Reliance at 1500, and if the market price becomes 14, you can say, boss, sorry, I won't buy from you. I'll go to the market and buy because you bought an option. So the option buyer has the right to either continue the deal or back out of the deal. But the option seller does not have any such right or this. He has only an obligation. Okay. So let's understand the meaning. The person who buys an option is the long. Okay, now remember, long is not buying the shares, underline. So the person who is long of an option, this guy being long, he has the right. Now, what is the right he has? The right that he has can be either to buy the underline or he has the right to sell the underline. But he has the right. That is important for you to understand. Right here was come. That right could deal with buying or selling. Correct? If tomorrow he feels that no, it's not worth buying or it's not worth selling, he can back out. Why? Because he is long. And long is nothing but the fellow who has purchased the contract. Correct? If this guy has the right, who has the obligation? The fellow who is short. The one who's short has the obligation to see through the deal. He has the obligation to satisfy the long. If the long says, no, I want to buy, this guy has no choice but to sell. If the long says, I want to sell, he has the obligation to buy. So if this guy opposite is this guy, he will buy, he will sell. His right will be matched by his obligation. If he decides not to buy, this guy will say, fine, no problem, I'll not sell. But he is at the mercy of this guy's choices. Why? Because he's long and he's short. Now you wonder, wow, so much power is into this guy. That's amazing, right? Don't worry, this comes at a cost. This guy who went long and has a right, he pays a cost for the right, and that is called as a premium. He is paying a premium of whatever amount towards having the right. This premium is received by this guy. This guy receives a small premium of whatever amount, and because he received the premium, he already earned the income, he will satisfy the obligation. This guy is going to pay the premium and will enjoy the right. Are we clear? So in an option, I have a long who's the buyer and I have a short who's the seller. The buyer has the right, the seller has the obligation. Are we clear? Now I also told you that his right could be to buy something, and when he has the right to buy something, that's called a call. So he's saying, I want to buy something, I'm calling it. If he has the right to sell something, that something sell is called a put. So when I say someone has a long call, it means he has the right to buy. If I say he has a long put, it means long means right and put means sell. So right to call, right to put, right to buy, right to sell. Long call, long put, right to buy, right to sell. This is the contract. Now in life, when you ever do an option sum, always do it from the long point of view. The short is always going to be satisfying the long. So if the long is going to make 50 rupees, the short is going to lose 50. Whatever the long is going to make, the short is going to lose, you turn minus sign. That's it. Clear? Obviously, premium. The long is going to pay premium, so he's losing 50. This guy is receiving premium, so he's gaining 15. So remember, the game is a zero-sum game. What he makes is what he loses. What he loses is what he makes. That's it. Are we clear? Okay. So we learn the concept of call and put, rights and obligations. And options are also exercisable when. Now learn this carefully. European option hai, so you can exercise it only on expiry. You can say, boss, when it expires, I can exercise. I can't do anything. But American can be exercised anytime. If I want to sell the option before the due date, I can sell American option. Correct? Now, obviously, options are traded on exchange. So you don't have to go and find the guy from whom you bought and sold. You can just go to exchange and buy it, sell it, or buy it. You will get your best price. Yeah. So European only at maturity, American only. Sorry, rather anytime you want to sell or buy it. Yeah. Obviously, therefore, American options are much more valuable because you have the right to buy and sell them whenever you wish. Correct? Now, this is very interesting. This is a nice diagram which will help you understand how the people make a profit or loss on maturity or expiration of an option. Clear? Now, we go into diagram. Let's understand. Okay, I'll send some key terms. What is P off? P off is nothing but the amount paid at maturity. Correct? That's called payoff. Okay? And profit word means the payoff you received, but don't forget you paid a premium at the start of the option contract. So when I bought the option, right, on day 0, I paid premium. So premium is a sunk cost. I paid premium. But on day 30, let's say maturity, I am going to get a payoff. Now remember, payoff will always be positive or zero because I'll never lose. So what is premium minus payoff? Rather payoff minus premium. What is the net amount? That net amount is called as the net profit. So in the exam, they say compute the profit. You have to find the payoff and the premium and minus. If they say compute the payoff, do not minus the premium. Is that clear? Okay. Now you understand payoff will always be positive. We always told you because you have the right. So therefore, the payoff formula is what is the maximum of 0 or this? If this answer is negative, then the answer will be 0 because you can never make a loss. So let's understand the call option. This is call. Now what is call? Call option means the right, I'm looking at long point of view, the right to buy. Correct? Now if you're buying, you will profit when the market price goes up. Correct? Now what does X stands for? X stands for the exercise price. It means that I have the right to buy at 40. So I can exercise at 40. Correct? I'm paying a premium. C0 means the premium. I'm paying a cost of $5. Clear? Now, if I have the right to buy at 40, that means obviously till it becomes 40, I'll do nothing because it's an option, I'll do nothing. But when it becomes 40, I'll start exercising my right. Correct? So it goes like this. From 0 till 40, I will earn no payoff. After 40, I'll start earning money. Right, this is $5. So after 40, at 45, I'll earn 5. 50, I'll earn 10, and so on. I will earn unlimited payoff. Right? So till 40, I earn no payoff. But understand one thing, at 40, I earn no payoff, but I still lost $5. So when will I earn no profit? At 45, because here I earned $5, but I have to pay my premium. So if I draw a profit diagram, it will look like this. I lost $5 till 40. At 41, I lost only $4, $3, $2, $1, and at this I lost $0. And after this point, I will make money. I'll make 1, 2, 3. So this is my profit, and this is my payoff diagram. Is that clear? Now, what I'm going to understand is this: payout becomes positive after 40, but profit becomes positive after 45. Why 45? Because 45 is nothing but 40 plus a premium. This is a very important formula. You will break even at a point where the share price will go above the exercise price and the premium. This formula is important. And was a X price 40, and it's proved कि भाई 45 के ऊपर ही तो ये profit है. 45 is break-even point. So if you have another sum, let us say excess price is 60 and premium is $3, you say fine, 63. Simple. Yeah. So, and again I say this for long. Whatever the long is doing, the short is doing the ulta. Long lost $5, the short made $5. Right? Long went up from here, short went down from here. Long is unlimited, short is unlimited losses, long is unlimited profit. Simple. This is how you interpret a option diagram for call. Because call is to buy. So when you're buying, you want the price to go up so that you are benefited at a cheaper price. Clear? But when you're selling, you are benefited at a lower price because you're selling high and the price should fall. Clear? So buying ke liye evidence clear, long call, short call, and the payoff and the profit diagram. Clear? I will explain to you this payoff and profit. Please learn this well. Can you guys take a minute to learn this diagram and apply the diagram? That's more critical. So the diagram is very important to understand the concept of break-even point, the payoff positive negative, the payoff chart, vice negative, and so on. Learn that quickly. Make a note, guys, in your books or diagram. Okay. Now, same concept, but the answer and the diagram changes because I'm now looking at a put. Put is the right to sell. So when I want to sell, if I decide to sell something, right, at a price of $40 and I paid $5, this time I want the price to fall to below 40 because I will make money only when the price becomes 30, right? Say I'm selling 40. If the market price is 45, will I sell it? No, I'll say I'll go to market and sell. So here, the market price should be 30, 20 or 10 for me to exercise the price, right or wrong? So only when the market price is falling, so here it will be like this, 40. After 40, I will be making positive payoff. But remember, it will end at the point where it's 40 because when the graph price is 0, you're making only 40 because that's your strike price. It can't go below 0. Can it become negative? No, right? The stock price can't be negative. So when the stock price becomes 0, you're earning 40, right? But the profit is actually not at 40. It's at 35 because when it becomes 35, you made $5, but you also lost $5. So at 35 is a breaking point and When it becomes 0, you are earning 35. How I got 35? Same funda. Stock price, but this time minus 5. So 40 minus 5 is 35, and this is your break even point. So in a call, you realize the break-in point was 40 plus 5. But in a put, it is 40 minus 5 because here you're making a share price fall. So यहाँ पे minus होगा, but वहाँ पे make it go up, it'll be plus. Are we clear this formula? As I told you, break-in point is very important formula. If it is for a put, it is x minus p. If it's for a call, it is x plus c. Clear? Clear? And if it's a long put, you know this concept. And if it's a short put, it will go ulta direction. So long put, he make a profit here. Short put makes the loss here. Okay. You lost premium, you will always lose it till it falls below 40. This guy is always making the premium till it falls below 40. Here, same formula. Payoff is what? The difference between the stock exchange price only till it's positive. Here, profit is again same. Payoff minus the premium. Here, so call and put have completely different diagrams. Are we clear then? Now, time for you to apply your thoughts and tell me what is the answer here. What is the seller maximum profit and what is the maximum loss under the contract? Now, this is from a seller point of view. So you do one thing, you think of the buyer, no? Leave the seller. Okay, see, option seller receives $5 premium. He will never receive anything more because it's an option. So can I conclude that the maximum profit is $5? उससे ज़्यादा मिलेगा ही नहीं इसको. That's why it was like this diagram, right? The diagram was like this. Flat. $5 पे cap हो गया. उसके बाद वो नीचे ही गिरेगा. So $5 is maximum profit. What's the maximum loss? Now he sold it exercise price of $30. 30. That means if it falls below 30, he will lose money. So below 30 can go only till 0, right or wrong? If it goes till 0, okay, then he will lose the full 30, but he already made $5. So he will maximax lose 25. So he is going to max gain 5 and lose 25. Quite a big risk reward ratio, right? It's not less to 5. But obviously, even he knows that the share price becoming 0 is very unlikely. Correct? But you do realize that for a put, the short put, the put option seller will always have, please on these points, he has a maximum profit and a maximum loss. You cannot say he has unlimited loss. The short put will have limited loss and limited. So both profit and loss are limited for the short. Obviously, theoretically. Are we clear, guys? Theoretically, both of them have a cap on the profit or the loss that they're making. Any questions? Hear that? Okay. There you go. That's the solution. Maximum profit, $5. Maximum loss, 25. Diagram, just showed it to you. I could ask you one more thing. What's the break-in point? What's the break-in point? The break-in point, remember the formula, X minus premium. So here the answer will also be $25. You will be surprised. The answer for the break-in point and the maximum loss are the same. Obviously, break-in point is market price $25. He'll break even. वहां से तो 0 ही होगा ना. So he will also lose 25. Correct? So the answer is 25 for break-in point. Clear? Okay, so let's come back to our match the columns. What's the answer here? Guys, I'm getting no response from you. It's going to one-sided. Can you take a minute and answer this question? Come on, answer. What's the answer? Put option seller. Now remember, seller has the obligation, right? Obligation. So the seller is seller. But put means the right to sell, right? Now the seller has the obligation to satisfy the put. So put option seller. Put means the right to sell. So this guy will have to buy. Correct? Put is to sell, but from a long point of view. But to a seller, it is an obligation to buy. Call option seller. He sold the call, right? He sold the right to buy. So this guy has the obligation to sell. Clear? Let's see the numbers. If he has an obligation to buy, he has no risk, wrong answer. He earns a profit equal to premium if the underlying price is less than the exercise price. Now tell me one thing. When will this option contract be useless? Put. When will it be useless? When the market price is more than the exercise price. Then it's useless. And this is useless when the market price is less. Because this guy will not want more or less. He wants more. And this guy will want less. So if the market price is less, then it's useless. Because the market price should go up for the profit. Right? When is that happening? If the underlying price and maturity is less than the exercise price, underlying price and maturity exceeds the exercise price. So the answer is here. Right? Correct? Because the price is more, he earns a premium. Here, call option seller. Underlying market price is less. So the answer is here. Okay? And both of them, option seller and put and call, has no counterparty credit risk to option buyer once the premium. Premium pay ho gaya, he received, he is not bothered because that guy will find him. He has no risk because the seller has already made his money and he is going to pay only when the buyer contacts and says, boss, pay me the amount. So he has no further counterparty risk. Clear? So how to think of it? Think like this. Put here, the market price should be greater. Therefore, they are looking at market price exceeds. Then he's going to make no further money. Right? Because remember, put option will want to exercise when the market price falls. Correct? Above, he will not exercise. Yeah? So please learn the concept carefully. The answer is A, bottom, C up, and B, C. Yeah. Okay. So revise it carefully. Okay. Now we've done future, forwards, swaps, and options, right? Now the last concept for the day, then we'll wrap up our class. So this last concept called as credit derivatives. Credit derivatives. Now what is credit derivatives? I would call this effectively, so a CDS, I will call this a simple insurance plan. Like an insurance contract, I can call this an insurance plan. Okay? Because all of you know what an insurance plan is, right? What's an insurance plan? You pay money, a premium to the insurance company, and they will protect, they will obviously not protect, they will give you a payment in the event of death. Right or wrong? Same thing happens in a CDS. You are paying a premium to the company and they will pay you money in the event of death of the credit of the party you're protecting. Death means default or insolvency. So what are you doing? The protection buyer makes a periodic payment like insurance, and in return, the seller is giving you protection against a default. Let's say Vijay Malia, you gave him 1 crore and you took a CDS. if Vijay Mallya defaults, you pay me money. So kal agar Vijay Mallya defaulted, this CDS would have paid you the money because he defaulted. It is saying I guarantee. So this is like a guarantee program where you're buying guarantee and you're paying premium. Is that clear? And you're buying guarantee against what? Credit default. Against the default of credit of that customer. You are protecting yourself against that. Simple. Protection mil gaya, you're good to go. Clear? Credit default swap. Obviously, a greater probability of default or loss in default means you'll have to pay more. Agar that party is bound to default, then there's a boss, you better pay more premium, right? Right? So there's a greater payment and a wider spread in the event of a greater default. So higher the probability of default, more the premium. Less the probability, less premium. Yep. CDS is a very important instrument that helps you to hedge against credit risk, right? So in summary, the buyer is buying risk, right? And the seller is the one who's selling risk. He wants protection, he wants money. So this guy will pay him the spread or the premium, and this guy is paying him protection. He says, don't worry, if anything happens, I will pay you in the event of a credit default. Here, again, remember, it's only in the event of a credit default, not otherwise. Here, if that guy is defaulted, then you will get the payment. Here, CES. Any questions? All right. So that's what our credit derivatives CDS was. Look at the story it's going to show in terms of summary. Okay. And please learn this well. This is exactly what happened during the 2008 crisis. Okay. Today he will buy protection buyer. Okay. CDS spread 100 BPS, the seller. Okay. Now after one period, when the migration happens, the spread is around so much, buyer will get payment if there is a migration of payment, and the seller will have to pay, right? When the credit event happens, the buyer will demand the amount of loss he incurred into notion. So let's say he protected $1 million and he made a loss of 20%. So he will pay him $0.2 million. The loss is the loss amount into the notional. This is what the seller will pay the buyer. Is that clear? Okay. So remember, there's always a notional amount that they are going to deal with. It may not be for the actual amount of loan, but the entire notional amount. So this is how you will deal with the payment of LGD, which is loss given default into notional amount, right? If I'm saying if the default happens and you lose 20%, usko multiply with the amount of the loan, which is the notional amount, and you get 0.2 million. Clear? So please learn how to also compute the amount of protection and the payment. Clear? Okay, come back to our famous master columns. One guy will tell me what's the answer here. So who will buy protection? The one who transfers the risk of loss to an unlike party. So the buyer is entering a contract to transfer the risk. He's saying, boss, me risk nahi, right? You take the risk. So the buyer transfers the risk, right? The seller is receiving premium, correct? And both of them are doing what? Think carefully now. The seller is the one who is effectively what? Faces, so the options are seeks to gain from a higher issue credit spreads. Means the issuer, if it has a credit spread, मतलब default होने वाला है, correct? If you like to default, that will happen. Is it both or is it the seller? Okay, and faces an MTM gain on the CDS contract if the CDS spread of the underlying issuer falls. The CDS spread is again the amount of default, right? If that falls, then who will make a gain on the CDS contract? Credit protection buyer and the credit protection seller. That's interesting. So, because we are saying both, actually no, sorry, so it's both the buyer and the seller. So they both enter into a contract that transfers. So both of them enter into a CD. So I think potentially the answer might be enter into a contract, right? Now, who seeks to gain from a higher issuer credit spread? If the credit spread is very high, then the person will gain when he's buying the contract, and the seller will face the MTM gain on the contract if the CDS spread actually falls, potentially. Okay, so they are actually very tricky options. Let me just put it from here. Yeah, okay. So both people I mentioned enter into a contract, correct? Both of them enter into a contract to transfer the loss of gain, right? The buyer is the person who will always gain, because if the spread increases, that means default ka chance badega, and who will get the money from default? The buyer. So the buyer will gain if the default increases. When will the seller gain? The seller will gain when the spread falls. Correct? So remember, spread gaya upar, buyer will make money. The spread falls means default nahi hone wala, chance kam hai, so the seller will make money, right? But both the buyer and seller are looking to enter into a contract which will transfer the risk of loss from one party to another party. Clear? So we have two people here, a buyer, a seller. Buyer wants protection from spreads going high. Seller will be happy if the spread is low. Okay? So this is completely like an insurance contract. Clear? So any questions you guys have? Okay, so that's quite heavy duty. So quick recap. We did derivatives, we did forwards, we did futures, right? Forwards are commitments, right? Even this is a commitment, but in a forward, you're doing cash, right? So in a forward, you're doing settlement by delivery. In a future, you are settling by cash, right? Future is traded on the exchange. Forward can be OTC, correct? But both of these are commitments. How to avoid commitment? I'm giving you the world of options where you have a right and not a commitment, correct? And then we have swaps where you can swap one liability for the other. You can swap interest rate, you can swap shares, you can swap payments. These swaps can happen between parties. So there are four types of contracts. And in the end, we did CDS. We're looking at credit default, right? Where you're paying a premium and you're receiving protection, correct? You're paying premium, but you're getting protection against credit default. So we have covered these 5 types of derivative contracts in detail. Clear? Okay, any questions? So we'll pause there because we've done very high level, heavy duty drilling into all this. Tomorrow, we'll wrap it up by looking at the broad benefits, obviously some of the risks, and how do the users actually use this, okay? So please take this time to recap and revise what you've done so far. Go into details of the derivatives, understand what each contract does, understand the options diagram. We did the call option, the put option, because you have the right, so long call, long put, understand the diagrams. One goes like this and the other goes like this, correct? Understand the diagrams, how they are going in the pull, and try to understand the break-even point, correct? Where we said one is x minus c and the other is x plus c, correct? So learn the break-in points, where you break even and how the break-in happens, correct? And then try to compute those, okay? We also did the concept of payoff and the concept of profit, correct? So options are frankly the most tricky parts where we have many concepts. For which was straightforward amount you have to pay and you get the net amount. Here we did the no arbitrage pricing obviously, and we did the concept of interest rate differential. So a lot of heavy duty stuff. Don't forget it. Recap all of this for the next 1 hour again. Go through it. Any questions you guys have?
Now, basically, all the contracts, all the instruments that we learned yesterday, what are the main benefits of those derivatives? How would they really work, right? Now, the biggest benefit, right, the most important benefits of derivatives and derivatives contracts are to ensure that you are able to manage whatever risk you have and try to either mitigate it or transfer it. Okay, so remember here you're trying to ensure that the risk that is existing in your business is managed by transferring it, mitigating it, reducing it. So there are various words that we use in the world of CFA, right? And all of this effectively means one thing, mitigate. Okay, now mitigate potentially means reducing the impact of the risk. If there's a risk, it might hurt your business, it might hurt you in the terms of financial loss. I want to reduce the impact of that loss. Clear? Derivatives are one instrument where you're actually able to take short positions. Now, you know, especially in the Indian markets, you can't short shares, right? You can go long, but you can't just short a share. But through the world of derivatives, you can actually take a short position, right? You can probably go and sell a Reliance future or an Infosys future, which means you have sold the shares and you're waiting for the price to fall down and then you'll buy it back. Clear? So short sale cannot happen in the world of shares, but it can happen through the world of derivatives. Clear? One of the biggest attractions of derivatives is the costing is kept very low and also the leverage. Okay, so remember when I want to buy, let's say, 100 shares of Reliance, if you buy through derivatives, you are not going to incur the cost of 100 shares. You will probably pay what you would have paid for only 20 or 30 shares, because when you use derivatives, you're using margin, you're using funding. So they are not going to make you pay the entire cost. Therefore, your transaction cost is also lower and your cash cost is lower, both. Okay, transaction cost is low because if you had purchased, you would have probably paid a certain brokerage on the entire transaction. But when you're purchasing derivatives, the amount you pay as margin itself is very low, because of which the amount of brokerage, SCT, CTT, government taxes, GST, all that is much, much lower. So margins are low, right? And therefore the amount of transaction cost, that is also kept very low. So effectively, your purchase cost becomes very less. But this is also a danger, because effectively, if you're buying 100 shares by paying lesser amount, remember your potential for gain is very high, obviously, but your potential for loss also is very high, right? Greater liquidity in the world of data, you can actually buy, sell very quickly. Therefore, there's high amount of liquidity. And if you remember, yesterday I taught you the concept of no arbitrage price, right? So if there is any arbitrage opportunity, arbitrage profits that are available in the market, where the security are not correctly priced, then derivatives can be used to rectify the prices and improve the efficiency of the market prices. Okay. In fact, derivatives helps you make sure that the market prices are not mispriced. Okay. Obviously, the informational discovery, it helps to reduce the volatility and maintains it. Like we saw yesterday when we did for few forwards and spots, right? And we said forward is equal to spot into 1 plus into, the R factors, 1 plus R upon 1 plus R. we are able to estimate the future prices of various commodities of goods by using derivatives. Clear? And expected future interest rate, same concept. I was able to actually find out what is the interest rate. So I told you I can find future using spot rate and interest rate. Similarly, if you give me the futures and the spot rates, I can also find out, and I know spot rate, I can find out what is the future rate, right or wrong, because these are given me. This is missing factor. So I can find the future interest rate by going behind the derivatives. Clear? So derivatives has a lot of benefits, obviously, and today it's a very big part of our world. It's very integrated into the stock market and other markets, forex and others, so and so. Clear? You'll see there are many obvious efficiencies, right? Important ones being that it is able to give information and it tries to estimate prices for the future. Even today, if you see silvers and a silver price falling, the futures prices are able to help you understand what could be the impact on the price of silver, right? So the future prices are an indicator of what's likely to happen, and that comes from derivatives, right? Take a minute, guys, and tell me match. So you guys can do like this. Do like what is A1, A2, A3, B1, B2, B3, and B and C. Take a quick minute and match it. Just tell me what's the answer for A, B, and C. Right. So for A, what's the answer? Price discovery function, operational advantages, and risk. So the other meanings of the words, price discovery, what is it? A, guys, operational advantages and risk transfer. Answer, guys. Can you unmute and answer? उसमें क्या है?
अपना हो जाए
हाँ?
अपना हो जाए
चलो इधर रख. Where will we go? Where will this go, guys? Are you looking at it or not? Everyone, what's your answer? Price discovery means you're trying to discover or find the price, right? Operational advantage is risk transfer. You can try to eliminate or look at the other ones also. I'm waiting. You can see the screen, right, everyone? The first one says price discovery function. So what does price discovery mean? It means you're able to discover or know the price, correct? So you're able to discover the price. So which of these options says that? Obviously, you're saying the costs are quite low compared to cost of purchase means when you're buying margins, you're the ability eliminate the time mismatch, and you're saying investors track the index price to gauge what is the sentiment. Means if you see the futures market, you'll come to know in which direction is the market likely to open. When the market's open, you know the market is going to open upwards or downwards. You're able to discover the price by simply gauging the futures or the derivatives market. I just mentioned the example, silver futures. When the silver futures was starting to crash, everyone realized the future silver is going to fall down. So it's basically an indicator. It serves a function of discovering what the price are likely to be. Clear? That is called price discovery function. Operational advantages. Now, operational advantage is basically where you're able to transact something and keep the cost low, right? And keep the operational cost quite lower at a reasonable amount. Correct? That is this amount where my requirements are low and the cost is also low compared to the cash market purchase. Clear? Because I have to put margins. So my cost of funding, my operational costs are much lower. Risk transfer means we're trying to mitigate the risk. Okay, risk could be anything, could be timing mismatch, could be matching your rewards and risk. So here I'm trying to eliminate the timing mismatch between the decision and the ability to transact. Okay, so price discovery is through stock market in the morning, engage in the market opens. Operations has many connotations to it. It has about margin trading, putting deposits, transactions, costs are low, low brokerage, and so on. Okay, and this look at this price, operational, and risk transfer. Okay, So what are the risks of derivatives? Now we discuss the benefits. What are broad risks? Obviously, the biggest risk is that with derivatives, there is transparency, but people don't really understand the full impact, right? If you see yesterday, what I taught you yesterday was just a tip of an iceberg. I taught you interest rate swaps, I taught you futures, forwards, options, call, long, short. But all that is really just the tip of the iceberg. You have to understand it more depth. So transparency is not known by most people. You know? And that's tricky because this instrument is not easy. In fact, there are so many exotic swaps, exotic derivatives, and other instruments. Clear? Then you have basis risk. Basis risk is where your risk is not being matched. Okay. Now, when you are trying to hedge the risk with another instrument, okay, of one instrument with derivative and so on, you're trying to match, there'll always be some risk which is not left matched, which is not matched completely. Okay. There'll be some residual risk, and that could be the basis risk. Okay. When some things are mismatched, mismatch could be of expiration date, could be of the transaction itself, could be of the amount, and while be mismatched because you may not find a derivative which is going to match one to one for the entire amount. Clear? So that's called a basis risk and a mismatch. Then you have liquidity risk. Okay. Liquidity risk is where the instrument cannot be easily liquidated and exactly matched with the outflows. Okay. So example, let's say I've tried to take an interest rate swap, right? A swap for my interest rate. So I'm paying a certain rate of interest. Now, if I take an interest rate swap, it may be possible that this instrument interest or cash flows are not exactly matching the cash flow that I'm paying on my actual loan. That could also be because the exact amount is not available, or maybe there are some, other costs which are not covered, right? So if the entire risk is not covered, the entire cash flows are not matched, you may have a liquidity risk because you might have to pay out more money which is not being matched by the derivative. Clear? So again, it's similar to the above point basis risk. A mismatch of cash flows, a mismatch of certain terms and transactions could be the risk. Clear? The biggest, and obviously this is mitigated, is counterparty risk. In a counterparty risk, basically is the risk that जो सामने वाला है transaction में, that person, he may not, what do you say, honor a deal. He may disappear. Clear? So in the counterparty risk, if you are making a profit, your contract may not be settled by the other person. In that case, what do you do? Clear? Therefore, we have margin requirements. We also have exchange traded, right? So you should not go and deal with another party. You should do exchange traded. If you do OTC, which is over the counter, then there's a risk that the other person may disappear, may just go away, may not settle. But when you do exchange traded, there is zero credit or counterparty risk, right? But credit risk is also going to be there because sometimes margins are there, but what if the person suddenly, so what if the person does not put a margin, or there's such a huge crash that the margin is not sufficient? All these factors could be there. Clear? And lastly, systemic risk. Systemic risk is excessive speculation. Okay. Now, basically, everything is within the limit. Systemic means within the system, whatever risk is there, that is going to have a huge impact. Okay. It could be in excess. And here there could be excess speculation or excess usage not in the right manner. Remember, derivatives should always be used to manage and mitigate your operational risk. It should not be used for speculation. But honestly, most people in today's market are using derivatives for speculative purposes that defeats the very purpose and benefits of using derivatives. Clear? So got the broad risk, transparency, basis risk, liquidity, counterparty, and systematic. Match the risk, guys. Now try to understand if these risks are what you learned right now. Can we just did it? So I want to see whether you're able to connect the dots. Liquidity risk, basis risk, and systemic risk. Yeah, what's the answer? Right. So liquidity is what? Okay, let's go there. Risk that excessive risk taking your leverage contribute to market stress. There's a lot of risk taking, sometimes use of leverage also. Go back to you already did. Excessive speculation, negative impact, right? No systemic risk. We see the word leverage here, not directly, right? Basis was mismatch between various underlyings, right? And we had liquidity risk, fairly simple. We talked about mismatching the cash flows with those of the existing risk. Okay, so can we start? What is liquidity risk for sure? Liquidity means, remember we said short-term cash flows, right? Which we have learned in the past also. Short-term and cash flows. So this has got to do with the cash flow timing. Risk of divergence in the cash flow timing of a derivative versus that of a transaction, right? Now, which ones comes up and down? Basis and systemic. Yes, come on. So basis risk is means your basis might not be sound. You expected something and the basis did not turn out to be as expected, right? See it here. Basis risk, where the mismatches are happening from what you expected. Systemic risk, I told you, is the risk of excessive risk, excessive speculation. You do something in excess and you're not able to use for the right benefits. Correct. And basis risk is where your expected values are not matching with your underlying transaction. Okay, your basis was not effectively sound. Clear? Okay. So when you study these, please look at these match accounts. These are good ways of testing yourself. Please ensure what you study, you're testing yourself in terms of the overall concept. Clear? Any questions? Corporate issuers. Okay, now obviously corporate issuers, they will go ahead and they tend to issue these debts, debentures of derivatives. Now basically in terms of and if you I don't know if we finished, yeah, we've done this in your FRA. There's a bit of corporate issues as well. Okay. Now here when you want to reduce the duration risk, okay, what is duration risk? I don't know if you know concept. It was then fixed income. I've probably done this. Duration is the volatility in the interest rates where you're putting it, and fixed rate and floating rate are the rates of interest that two people can have. You can either fixed rate debt or a floating rate. Now, fixed rate means you're going to pay like let's say fixed 5, 7, 8%. Floating rate is when the rate is pegged to the let's say the LIBOR or the interest rate. Example, now RBI has recently reduced the interest rate. So everyone who's playing floating rate is getting the benefit of the lower rate. Correct? So the fixed rate and floating rate, if you have a interest rate swap, then there's a duration risk between the floating and the fixed rate. Clear? Those can be hedged. Let's say airlines, best example, Indigo, Air India, they have sold the tickets from before. The tickets on the airlines are sold a month before at times. But the fuel cost is incurred when the flight actually takes off, right? What is the fuel cost suddenly increases, which has happened many times. The fuel cost, the petrol cost, the oil cost, they're gone up. After the flight, now I hope you do realize, I'm not sure the exact number, but any flight, any flight would require at least 400 to 500 liters of fuel, right? That's a huge cost, right? I mean, it runs into lakhs. So if my fuel cost suddenly goes up, I'm going to suffer a loss of almost 20, 30,000 suddenly on one flight. So I can't risk that. So what I'll do, I will fix my fuel cost by buying jet fuel futures. So the futures I buy will allow me to buy fuel at a fixed cost and not be at the mercy of the fuel uncertainty. Clear? So this is a very good operational way where derivatives are being used to hedge your risk. कि भाई fuel cost अगर उड़ गया तो for that even fuel, even other these steel companies, they तो use almost thousands of tons of kgs of steel every day. And steel cost, if it goes up by even 20-30 rupees a day per kg in one day, that'll be a setback of almost 20 lakh rupees. Imagine. So even they will buy steel futures. They'll say, fine, let's fix the price of steel so that tomorrow, if the steel price goes up, they are not impacted, right? So futures like steel futures, oil futures, petrol futures, the companies that use these inputs a lot every day, they will always buy the futures and keep it handy. Clear? Obviously, international corporations can hedge uncertainty about future payments also through fuel and futures. Okay. Last one. Let's say you are exporter, you exported to US, you're gonna get $1 million. Correct? Now at today's rate, you're gonna get 92 million rupees. Brilliant. But what if 92 became 90? What if it falls? The $1 million that you got, you'll now get 90 million rupees. That means you lost 2 million rupees. Is it acceptable? Correct? So, because you're receiving future payments in currency, if you don't hedge it, now what you could have done? You could have gone ahead and taken a dollar future and said, I want to sell dollars at 92. Fix it. अभी अगर डॉलर 90 हो गया तो तुझे 92 ही मिलेगा. हाँ, बट ये भी है कि अगर डॉलर 93 हो गया या 95 हो गया, you will still get 92. Correct? But remember, the end game here is not to leave you unhedged and to give you a profit. The game here is to make sure that you are able to have a certainty on the future. Derivatives are here to mitigate risk, to remove uncertainty. Samjha? To remove uncertainty, and I want certainty. This is where it is. So I want to know at what amount my $1 million will be converted. That certainty comes from the world of derivatives. Clear? Right? And then obviously you have fair value hedging. Fair value hedging. So you have unlevered positions, you have forward futures, you have long positions, long underlying. So let's say I have an investment in Reliance shares, it's an example. You have it with you. But you want to hedge yourself, you want to protect yourself. Ki bhai agar kal the share price falls down, what do I do? So simple. Go and sell a forward. Short a forward. When you short a forward, it is protecting you from any fall in the long. मेरा जो long position है उसका price गिर गया तो the short forward will help me. Clear? Same way, if you have a short underlying, then no problem. Go for a long forward. But if you shorted some shares and you feel the price uh, should fall. But what if the price goes up? Then you're finished. So you say, fine, no problem. You go and buy a forward. Agar price upar gaya to forward will give you a benefit. And that benefit will offset your losses. Clear? So you're basically hedging the fair value of the various positions that you are taking. Clear? Through a forward or through a future position. So agar tum long ho, to short karo. Agar short ho, to long karo. You are effectively hedged. Clear? But do ensure that you're not having a mismatch. That's more important, right? And this is very critical accounting in the world of hedge, where often accountants are caught out and not able to do the right accounting. Just understand the concept. You don't have to learn accounting, you just have to understand how it gets accounted. That's it. Okay. I won't go into debit, credits, or valuation here. Okay. If it's a cash, just need one. If it's a cash flow hedge, right? That means you're taking a hedge to mitigate the variability of the cash flows, right? Let's say I'm going to own a certain cash flows. Now, I don't know whether the cash flows are going to be certain or not because there may be other transactional factors. So if I use a derivative to try to offset the variability in the cash flows, that is called a cash flow hedge. Okay. Now remember, cash flows, not fair value. Quick example, I took a loan and in the loan I have to pay a LIBOR interest rate. So LIBOR might go up 6%, 7%. So that means I have to pay LIBOR, say LIBOR plus 1, okay, on a $1 million loan, right? अभी अगर LIBOR is, let's say, 7%, I have to pay 8% into 1 million, right? What if LIBOR became 8%? So I have to pay 9%, right? So, or maybe if LIBOR falls down, then I have to pay maybe 6%. So if you notice, the amount of interest I'm paying in cash flow is varying, right? कभी 8% दे रहा हूँ, कभी 9% दे रहा हूँ, कभी 7%, मतलब बड़ा amount change हो रहा है, right? 6%. This cash flow is uncertain. पता नहीं मुझे कल LIBOR कितना हो जाएगा. I'll have to pay interest. So this variability in cash flows, if I'm looking to reduce, I can reduce it by using an interest rate swap. Make sense? I use the interest rate swap to reduce my variability in the interest cash flows, right? And obviously it helps to bring about more certainty in my this. Clear? This is one example. I said the dollar, if you're buying dollars, we're receiving $1 million, you feel your cash flows might be less in the future, go ahead and go sell a dollar future. So whatever foreign currency, whatever transactions, money is coming, uska uncertainty is reduced by using a derivative that gives you a cash flow hedge, right? Now cash flows can be hedged by interest rate swaps and so on, currency futures. Fair value hedge is where I want to hedge the fair value. I have shares of Reliance, standard example, 1500 ka hai. What if fair value goes up, falls to 14 or 13 or 12? Fine. I can go and sell a Reliance future at 1500, which means if the price comes 14 or 13 or 12, I'll still get 1500. Or I can go and buy a put option. Put option right to sell. I'll say I want to sell at 1500. Agar share price niche gaya, I'll sell 1500. If the share price goes up, I will sell at the higher price because I have a put option. Got it? But what are these? These are fair value hedges, where the fair value of your instrument or your assets are protected or hedged by using the derivative. You're offsetting the fluctuation in the fair value. Yeah. Third, you'll be surprised the concept, but it's a net value hedge. Now remember, often many subsidiaries are, foreign subsidiaries. A parent is a foreign parent maybe. So suppose you have a foreign subsidiary on your balance sheet. Let's say the parent. The parent is UK parent. Uska ek subsidiary US mein, it's in India as well. So I have an Indian subsidiary and a US subsidiary in the books of the UK parent, right? Parent is UK and he has foreign subsidiaries equity. Equity means investment, right? Now you do realize this equity value is in dollars or rupees in the books of a pound company. So you have to understand that the value of this investment will also come to you in dollars or rupees, right? Forget that the balance sheet will be consolidated also in dollars or rupees. So how will I take the same cash flows? The cash flow might change, the year-end rate might be different. So every time I take the consolidation, the value will change. To avoid this, I can enter into currency forward. Where I'll say the currency is so much, the forward rate is so much, and I'm hedging the value of this subsidiary's equity. Clear? So that is what is my cash flow hedge, fair value hedge, and a net value hedge. Clear? Any problems here? Okay, so this is a good slide which shows the various factorial scenarios in which corporates do hedging by using instruments. Okay, so we have cash flow hedge, fair value hedge, and net value hedge. Okay, only these three types of hedges. Any queries on these points? When you guys say there's no queries, I assume you understood that. So let's go ahead and solve the sum. What's the answer? A, B, and C. Cash flow hedge. What's a cash flow hedge? Going to hedge. Come on, the answer there in this. Okay, so what is the cash flow for?
So cash flow hedge would be number 2.
Very good. Variable cash flows, very good, are being absorbed. You're trying to reduce the uncertainty of a cash flow, interest rate, and so on. If it's affected, good,
That would be number 1, sir.
very good. So fluctuation in fair value. Fair value might fall up or down. Okay. Example of this could be equity future. Let's say you're buying stock future. If you feel the price might go down, you'll want to sell the stock future and protect your price, right? And obviously, net investment hedge pertains to derivative for foreign operations, right? Equity of a foreign operation. That is your net investment hedge. Clear? Good. So cash flow, fair value hedge, and net investment hedge. Well done. Good job. Okay. Now, what I discussed in this slide is how corporate issuers, companies are using derivatives to hedge to mitigate the risk, right? Now we'll come to how investors are using derivatives. Obviously, investors have to use it for the purpose of offsetting their risk in investment, but also very often investors might speculate. I told you 80% market is speculating. They may speculate, "Acha, theek hai. Reliance share price might go up. Okay, let's not buy the share, let's buy the future. Because future mein kharida, so you can at least buy it with a greater margin, a greater lot, right? So speculate on silver by buying a forward contract, speculate on stocks by buying a forward contract, by buying my future contract, or you can buy an option, you can buy a call option or put option, but that involves a cost. So you can do various things by dealing with uh, futures and derivatives, right? You can also manage the duration. With duration, the interest rate risk, right? By of a bond by buying or selling a interest rate swap. Okay, which is a fixed rate swap. So you can deal with a suppose you have a variable rate you're playing in LIBOR, then you can also swap your rate to a fixed rate by entering into interest rate fixed rate swap. Okay, where you convert your floating to fixed and vice versa. Okay, examples of altering risk is very straightforward. Let's say you want to change the risk of your portfolio. क्या करेगा? You can buy the entire index like forward, right? Or you feel it's too high, you can sell the index. Okay, or you can buy limits limit in you can put index buy index puts to limit down your exposure. Yeah, let's say exposure downside, you feel it may fall below certain level, so you'll say, okay, I don't fall below a certain level, so I'm putting a limit downside exposure. Okay, or I can go for leverage long that I'm buying with margin. Now remember, investors normally are using margins and derivatives as a way of speculating. That is dangerous, but you're still trying to make sure that you're making a higher profit at a lower cost. Okay. So quickly now, or what we done in the last 3, 4 slides from the issuer's point of view and the investor's point of view. Corporate issuers, investors, what are the broad benefits and aspects? Start. Investors, what they do? The word commercial operations. So remember, issuers are corporate issuers, the companies. What does one refer to? Investors do it, or issuers do it, or both do it?
So maybe issuers because the commercial operations.
Correct. Yeah, makes sense. So issuers, because I've highlighted a word, commercial operations, financing activities, these are not for investors. Investors are not doing commercial activities, right? It is issuers. So the word commercial operations and all the exposures, risk pertaining to their commercial operations are taken care by issuers, right? Good attempt. Who uses derivatives to change the exposure to underlying asset price without transacting in the cash market? Both or only investors? And so, do issuers also invest in exchange traded derivatives? Or they do OTC also? Because OTC is others, right? Who does OTC and exchange traded? Can I say issuers also do exchange traded more frequently? Or they do OTC more frequently? Issuers. And so,
Exchange traded.
is done by whom? Both or investors? Think about yourself. If you go and do a derivative, will you go and do an OTC transaction? Will you do a derivative with some other person, or will you do it through the exchange? You. So most investors, almost all of them, always transact in the exchange rate market because the OTC market, I told you, has a high default risk. कौन बेवकूफ बैठ के OTC करेगा और default risk भी लेगा? Investor like boss, मुझे buy करना है, sell करना है, किस पे नहीं करना है. A issuer may want to do interest rate swap for $1.5 million. ये सब नहीं मिलेगा market में. A swap and all is done by issuers. They have to do OTC. They have no choice because many of the derivative positions are probably a little customized. But investors क्या है, उसको जाके देखना कौन सा बढ़िया कम होगा. He'll just buy, sell what is available. He will always deal with exchange. He will never deal with the OTC because his risk of loss is higher, right? And who is the derivative to change the exposure? Both. I want to use derivatives to change my exposure and make sure that I have a better exposure to the price of the underlying asset. So without transacting the cash market, I'm trying to get an exposure to the cash market. Clear? Any doubts on the answers, guys?
No, sir.
Others? Okay, good. So this helped you understand the key difference between investors and issuers and what they look for. Okay. Yours. Okay. And now we'll come to the concept of arbitrage. Okay, which we had picked up a bit yesterday, and replication and cost of carry. Now, how do we price derivatives? Okay, that's very critical. What's the pricing of what's the value of derivatives? Okay, what should it be ideally priced at? All of this comes through the concept of arbitrage and replication. Clear? Remember, I taught you and keep repeating this understanding that arbitrage helps you to find the price that is the real price of the market. Okay, and you're able to also spot what is the differences in today's price and the expected price, and that helps you to find out where the market is headed. Clear? Any questions? Okay, so now with this aspect, we'll move on to arbitrage. Sorry. Yeah, let's come back. My bad. So when I use the word arbitrage, guys, remember the word arbitrage refers to the concept of finding out the fair price. Okay, so suppose I have two assets. The two assets have the same expiry, the same payoff, the same life, the same features, the same risk. Obviously, it means that both the assets should be selling at the same price. If one asset is being sold at a different price, then immediately people will come, they'll buy the cheaper asset and sell the higher asset and they'll make a profit. Or let's say the same asset sold at different prices in different countries, right? Let's say, quick example, arbitrage. Let's say the same, today if you see there's a lot of arbitrage happening. iPhone is cheaper in Dubai, right? Or USA. So what do people do? They'll buy from USA and they'll get to India. You can do that, but you can't do it for like 1 or 10, 20, right? You can do for one. Now imagine if tomorrow people go to Dubai, USA, they'll buy 10 iPhones, get it to India, and they'll sell it at higher price because in let's say USA it is around 70,000, India is 1 lakh. So he'll make a 30,000 profit, right? Now this is arbitrage where person is going bindas buying 10 phones, making 30,000 rupees profit per phone without taking any risk. This is wrong. So what do customs and Indian duties do? They say, fine, we will charge you a duty equal to 30,000, which is nothing but the difference between that country and this country. So I'm avoiding arbitrage. I'm not allowing you to make a riskless arbitrage profit by putting duty. Why do you think duty is put? To prevent such occurrences, right? So when there is an opportunity to make riskless profit, that is called arbitrage. Now, who are arbitrage? The people who try to exploit the opportunities. They will reduce the price differential to zero So suppose iPhones, let's say there's huge opportunity, then people start buying from Dubai, get to India, sell. When that starts happening, Dubai prices go up, India prices go down because India with the most sale, Dubai no price. So the difference that's there in the two markets, maybe what a 10, 15,000 difference, that difference will immediately be eliminated because arbitrageurs are taking action in this market. Understood? So arbitrageurs help the price difference to become zero and no riskless price profit should be allowed. That's what arbitrageurs help to do. Clear? We discussed no arbitrage profit pricing yesterday also when we went to derivatives, right? Futures and spots. That's important. So remember, a derivative can be replicated through portfolios also, correct? And this is called replication. So when basically I'm saying that I can mimic a certain cash flow by using derivatives. Clear? So I can replicate or mimic, okay, a certain derivative or through a portfolio that has payoffs. So I can use a derivative to mimic a portfolio. I can also use a portfolio to mimic what a derivative would have done because derivative would have prevented me from incurring a loss if price goes up or vice versa. I could do that with a portfolio of shares also, right? Look at an example for you. If you have a long forward, now so long forward, I have the obligation to buy Acme shares at 31 in the future. मतलब आज 30 पे है और मैंने एक forward contract ले लिया 31.5. Obviously, it may go to 35 also. But you took a forward contract at 30. So what will happen? You have the obligation to buy these shares at 31.5 in the future. Right? Now, imagine it's nothing but buying it after 1 year, right? For 31.5. Let's say you went and borrowed a loan. You took money from a bank at 30 rupees, at 5%, 30, right? So you're saying that I want to buy it at 31.5 in the future. Imagine you go and borrow 30 from a bank and you use the money to buy one share and hold it for 1 year. So what's the cost? Nothing because you borrow the money. You paid nothing today because all you did is you borrow money from bank and you said I'll pay you 31.5 with interest after 1 year, right? Right or wrong? So after 1 year, effectively, you have to repay the bank 31.5 and the share is in your pocket. So at settlement, you are paying off 31.5. Same thing with the derivative. At settlement, effectively, right? You are paying 31.5 because that's what you took the forward for, 31.5. So you got what I'm saying mimicking? I took a forward to buy a share at 31.5. I took a loan, bought the share and paid 31.5. In both cases, my payoff is 31.5 after 1 year. Clear? But what is the beauty here is this 31.5 is also the no arbitrage forward price because you are able to borrow at 5%, pay 31.5 and you are paying 31.5. So both of them are a same price. Let's say you got an interest at a cheaper rate, you would have paid 31. Then I guess अरे borrow किया तो 31 दूंगा. If I buy forward, I'll pay 31.5. So it's cheaper to borrow. I'll borrow more and sell more. I'll earn an arbitrage profit. So here, luckily, the settlement price is the same after 1 year, and that is called the no arbitrage because by this price, you don't have to you're not suffering any riskless profit or loss. So I call this the no arbitrage 1 year forward price. Clear? And how do you get it? Same like yesterday's formula, spot into 1 plus R raised to n. If you do the maths, 30 into 1 plus 5% raised to n raised to 1 comes to 31.5. So we say the theoretical no arbitrage forward price is always equal to the spot price into the 1 plus R factor. Clear? This is how you arrive at no arbitrage forward price. Any questions? Okay, so I've taught you how to replicate the cash flows and same time find out what is the suitable price at which you are neither better off nor worse off. Right? What I just explained to you, that's your formula. Clear? Forward equals to spot into 1 plus R. Sorted? Obviously, if you take S on this side, you also get a formula where you get forward upon spot is equal to 1 plus R is to T. Right? And you can interpret it in different ways. Okay, you can sell the asset in the forward, you can buy the asset now, hold it for time period, and so on. Okay? Now, they've given the explanation what I just explained earlier, some, right? Forward is 32. So if you look at this forward example, you know that the forward price should be equal to 31.5, which I showed you on the earlier slide. Correct? Now you will go and check कि भाई ये तो मेरा forward price होना चाहिए था for 31.5. But what is the actual forward price in the market? What if it's 32? Then I have a difference of 0.5, but it's not big. It's not big difference, but still a very big difference, because if I have 0.5 difference per contract, I can go and buy 10,000 contracts. I'll make $5,000 profit, right? So this difference will give me an arbitrage profit. So what do I do? Tell me, your theoretical price should have been 31.5, but your actual price 32. So क्या करोगे? What is costly, you will sell. What is cheap, you will buy. So you'll say, yaar, costly is good. Sell the forward, buy the shares. Simple. If you sell the forward, it's 32, and you buy the share at 30, and you take a bank loan, after 1 year, you will end up in a situation where एक हाथ से तूने 31.5 दिया, शेयर लिया, और दूसरे हाथ से वो शेयर को 32 पे बेच दिया. On day year end 1, you will earn 0.5 per contract. This 0.5 is riskless gain. If you make some 10,000 contracts, you're making 5,000 profits for taking no risk. Chalo. What if the actual price not 32 is 31? Then what? ये 31.5 है, इधर ये तो 31 है. तो superb. उल्टा करो. The cheap, buy the cheap, remember, and sell this. So I will go and buy immediately the forward, and I will short the shares today only at 30. Like, boss, ये तो अच्छा deal है. I'll short it, I'll lend it, and I'll get 30. After 1 year, you will receive 31.5 from the shorting, and here you will have to pay, correct, 31. Right? Because remember, the share price was shorter, right? So the forward price that you sold at 31, you will cover it at 30. Clear? So here you bought at 31. After 1 year, you'll go and pay 31, but you receive 31.5. You made 0.5. Here you bought today at 30, 31.5 pay karoge, and you'll receive 32. So in both cases, the answer is common. Whatever is costly, sell it. Whatever is cheap, buy it. Here 32 and 31 is costly, sell it. Here 31 and 31 is costly, buy it. Buy. Clear? But buy the forward, not buy the shares. Sell the, because it's a forward price. So buy the forward, sell the forward, deal in the underlying separately. Clear? So this is called cash and carry. जो मैंने खरीदा और फिर sell किया, and if I sold it and then bought back, it's called reverse cash and carry. So two types of arbitrage: cash and carry arbitrage and a reverse cash and carry arbitrage. Clear? And learn the terms. And remember, cash carry arbitrage is the arbitrage that helps you to find out what is the no arbitrage forward price. Clear? Look at this. Which of following is closest to the arbitrage profit available to investors who's able to buy an asset, right, for spot price £50 and sell a 6-month forward for 52.5. Imagine. So look here. The theoretical price is what you have to find out. The actual price is 52.5. $52.5. So what is the theoretical price? Find out. And you find out what is cheap or what is costly. Whatever is costly, sell it. Whatever is cheap, buy that. What should the price be? As for my formula, 50 into 1 plus what is R? 4%. How much time? It is only 6 months. So I'll do raised to 6 by 12. Remember, you have to do raised to n. N is number of months. 12 by 12, 12 months. If it's only 6 months, 6 by 12. Can you do it on calci and tell me what the answer is quickly? Come on. Do it on calci. What's the answer? What is this answer? Come on, guys, I'll try to interact more. Just being quiet and listening. What's the answer? 15 to? You have a calci or not? 15 to? This was the answer, you guys. So 15 to 1.4% raised to. So you have to do 15 to 1.04 raised to 0.5. Correct? Which is 51. Correct? Around 50.9 or something. And then you find 52.5. So that between this answer and this answer, I think it comes to 1.51. Check. There's no noise from your side at all, yeah. What is it? Yeah.
Subtract 52 instead of 50 because I did minus 50 and I got 0.9.
You got how much?
Why did we subtract 52 instead of 50?
No. 50 is just the spot price, right? What is the forward price selling at? Forward. The forward price today is at 52.5. So if you want to go into 6-month forward commitment, it is available at 52.5. Correct? Available after 6 months. So at time 6, this forward will give 52.5 and this spot would have become 51. Right? 50 plus 4% for 6 months. How much is that? 51. This is
51.
This is my cash and carry. So if I buy it in cash and carry it for 6 months, it is worth 51. But if I sold the forward contract, it's worth 52.5. So ideally the forward contract should have been worth 51 only because my cash and carry is 51. But it's worth 52.5. So I was able to make a riskless profit of $1.5, right? Because I can sell the costly one and buy the cheap one. So what I'll do, I will buy shares at 50. I'll take a loan, buy the share and sell a forward. After 6 months, the forward will give me 52.5 and I use that money to pay my bank loan of 51. I've invested no money from my pocket. I'm earning a cool $1.5. Is that clear?
Yes, sir.
Yeah. Now be careful. Answer is C, obviously. Some people may forget 6 months in the exam tension. If you forget 6 months and you did raise to 1 year, then the answer would have been 0.48. Check. And this is where you have to be very careful in exam. Look out for options and check and read every word. अगर 6 महीना लिखा है तो 6 महीना करो. Raise to 6/12. Do not ignore these things because these will alter your answers and the other option also will be available. They are going to fool you and they'll trick you based on that. Is that clear? Okay. So good example to understand what is the arbitrage pricing. Yeah. And this is exactly what I explained to you. I'll sell the forward and I'll buy the asset. Okay. If I sell the forward, I do this today And now after 6 months, I will receive 52.5 and pay the bank loan. I'll pay the bank 51 from there. I'll get 1.5. Okay. So sometimes they may also ask you what is the mechanism of cash and carry, or how will you do the reverse cash and carry. Okay. Cash and carry reverse and so on. Yeah. Now, what are the benefits and costs, obviously, of the no arbitrage forward price costs and benefits? Look at that. Okay. Now, the forward price I just mentioned to you is nothing but forward simple formula is spot price into 1 plus R, right, raised to N. Correct? Now it is possible, now look at carefully what I'm explaining to you. It is possible that in the spot price, if I buy the shares, I may incur additional cost and I may also earn some benefit during this 1 year that I'm holding it. I may earn dividend, I may earn some income, I may incur some additional storage cost. So all of this will be add and minus, and then you can do into 1 plus R is to N. Okay. So when I have benefits and cost within my cost of carry, counting cost of carry, right? Carrying cost कितना होगा? So cost of carry में अगर benefits और cost भी है, तो simple benefits को निकाल दो तेरे cost में से and cost को add कर दो. That's it. But remember, you're doing this over the next 6 months. Okay, over the period. So you have to take the present value of those benefits and cost, and that's how it will work. Clear? So what cost do you think I'm talking about? Storage cost, insurance cost. What are the costs you incur to buy and carry the asset? That is a cost that you want to add. And what benefits you might earn? You may earn yield, you may earn cash flows, you may earn interest, you may earn money from simply lending the asset, and so on and so forth. Yeah. So these are the various benefits. RF, in a way, RF also is a cost increase, the cost of carry for taking loan. But how am I taking RF into consideration? By multiplying it here. So I'm already increasing my cost of interest. So quickly, let's summarize. Benefits, क्या क्या आएगा? Yield आएगा, interest if you're earning, dividend if you're earning, and what are costs that you incur? You may incur storage cost, you may incur transportation cost, you may incur insurance and other cost, and most importantly, you'll incur rate of interest. This rate of interest is included in the upper part of the formula. These costs will increase your cost of carry, right? That's why we say cost and carry and reverse cash and carry. Clear? So cash cost effectively goes up and down. This. Now, what's the convenience yield broadly? Okay, convenience yield. Any benefit which is non-monetary. So I may earn a dividend income. That is monetary benefit. That's a cash flow. What's a convenience yield? It's a benefit you're earning, but not in real cash form. Examples. Is it the preference to buy forward contracts to avoid paying cash upfront? No. That is the derivatives market. Derivatives is where I have a preference, right? So the answer is no. Next one. Is a preference that exists for buying the spot market to avoid having to pay for storage. Storage is again a physical cost, monetary cost, and no one convenience yield is observed storage. Storage is a cost, correct? And convenience yield is a yield. It's a different concept. Yeah. Convenience yield reflects a preference that the market participants exhibit for buying in the spot market for non-cash reasons. You saw the word non-cash, right? So any non-cash reason that you exhibit would come from the potential convenience yield underlying cash market. Okay. So look out for the terminology and the word. Now I kept using the word cost of carry, cost of carry, a very good example. I want you all to tell me, very important, what is the forward price after 6 months? Come on, guys. I want everyone to solve it. It'll take you only 2 minutes. Tell me what's the forward price after 6 months. Answer. 6 महीने के बाद. Use raised to n. Shall be raised to 6. Start. Is the same formula. Yeah, what's the answer?
So it's saying that it pays.
Sorry?
It's saying that it pays dividend for 3 months, but then it is
Yeah.
asking for 6 months. So how will we
Correct.
do that?
So you have to do for 3 months only. You have to consider the factor of 3.
I'm sorry, sir. Can you repeat?
The interest rate only for 3 months.
Okay.
Okay, so because you remember, I'm asking you a time. So look here at this. It's time today at time 0. This is 6 months. And this is 3 months. Right? I want you to tell me the price here. Okay, so if you're earning something here, you'll have to consider that time value of money for only 3 months. Okay,
Okay.
there's no carrying cost here, right?
So no, but there's a benefit, so that will be subtracted, right?
Correct, correct. Correct, that's why I put minus. Good. So dividend is a benefit that you receive that will be subtracted. So what's the cost? Let's do it. What's the cost of 50 in 6 months? 50 into 1.05 raised to 6 by 12. Is that correct? This
Yes, sir.
50,
Yes, sir.
right, after 6 months will give me so much. What about this 0.3? After 3 months, how much will give me? 0.3. It'll be into 1.05, but it's 0.3, so it'll be 3 by 12. 3 months by 12 months, right? Because remember I got it in 3 months. So next 3 months, what's the value? Next 3 months. Okay, उसको minus करो. 50 जो ऊपर का answer था. And this 0.3 I received only after 6 months, so there's no need to do any further into 1 plus r. So you got your answer. This is my cost of carry. This is my benefits for 3 months. This is my benefit in the last 3 months. Clear? Good. Any questions? What's your answer now? Tell me. Based on this maths, only these 3 things you have to look at. I'm not sure if you guys are fluent to the calculator as yet or not. Well, I've not been using that. What's the answer?
So is the answer 50.66?
50.66. Okay, let me check also. This could be
So
50 points.
50.58.
You got 50.58. No, that's not possible. 50.66. 50.66 looks more clear. 50.64 maybe. Okay, if you're right. Now, if you do the round off, you will get effectively the value of how much? 50.63. Okay, but what I did is find out what is the future value, right? So I took 50, उसमें से 0.3 का for 1.05, correct, for 3 months. I'm not sure why you didn't get the answer, because you should get the exact answer. 50.63 मिलना चाहिए था. If you don't, did you do exactly what I told you to do here? 50 into 1.05 raised to 0.5, 0.3 into 1.05 raised to 0.25, and 0.3. And then do the first answer, my second answer, my third answer.
Oh, no, sir. I just did it raised to 3 divided by 20.
You replace what?
So in the raised to, I just did 3 by 12. Like I didn't subtract it. I just did that.
No, but if you subtract also, then that figure. So potentially, you guys have the CFA calculator?
Yes, sir, but it's a bit difficult to use. Like I'm not.
No, not all. The other person, you have CFA calculator?
No, I haven't got it yet, sir.
Why? You're so fine of syllabus and you're still seeing that one CFA calculator. You have to use CFA calculator online one. Let me show you. And it's not difficult at all. You feel it's difficult, but it's actually quite easy. Look here, I'll show you how it works. See. Okay, you can see my screen. Now you know the store function. Store is where you can store a number in a You can store any value like memory plus. Okay. Now, can you focus here for exactly 40 seconds? 40 seconds. Are you with me? Okay. You guys remember the sum or not? You can see my computer calci, everyone on the screen. Can you see my calci?
Yes, sir.
Yes, sir. Yes,
Okay,
sir.
now see, what is so difficult? Look at the screen. I am doing 50, right? Into open brackets 1.05, correct? Close brackets. And what is it? Raised to the power of, correct? Here, raised to the power of how much? 0.5, correct? So wait, 50, okay, into open brackets 1.05 है ना? Raised to the power of is here and it's 0.5. ठीक है? What's your answer? ये मिला तुम लोग को? Did you get this much?
ये सभी बोलेंगे क्या?
मेरे को तो दीदी फोन करेंगे ऐसा
अरे, एक मिनट आई नहीं, अब 5 मिनट रुकोगे? एक बार फोन कर देना उनको। वो बोली
तो मैं कल आ जाऊंगी।
नहीं रुक जाओ एक मिनट, वो पहुंच रही है, मुझे से पता नहीं किधर है, वो पहुंच ही रही। एक मिनट आ जाओ, बंद करता हूँ, एक मिनट रुको, आ रही हो। 1 minute. So you got this much, this answer you got so far? This much you got 51.23? Okay? Yes or no?
Yes, sir.
Answer, Namasi, 3 times till now, none of you are answering. Read it
Yes.
silently, look at calci and confirm. So this is the first part of the equation, right? Then I have 0.3 which you received. Now 0.3 I receive after 3. So what I need to do is this answer I'll put in my memory. I will store it in memory 1 because I'll forget this answer. Okay. Now I'll come to my second part. What is it? 0.3, correct? Into 1.05, but this is raised to 3 by 12, which is 0.25, correct? That's your second part of answer. It's something 0.3 something something. So I'll store this number now in my second call. And obviously the third one is 0.3, but that's not discounted. That will go and I'll store it in my third number. Okay. Now remember 1 minute, I'll just show you. My decimals, I want to put it as 4. Okay. So I'll set it to 4. Okay. Now see what I have stored in recall. I can recall 1. It is 51.23. If I recall 2, it is 0.30. And I recall 3, that also contains 0.30. Let us see the second one. 0.3 into 1.05 raised to 0.25. Yeah, it's this answer. This is my second value. And my third value is 0.3, which is not discounted. Now I'm going to recall first value. From that, I'll recall my first value. From that, I will minus my second value. And from that, I'll minus my third value. That's the answer you got.
Yes, sir.
50.63. Are you clear? Is it making sense now?
Yes, sir.
You call everyone and you come. Clear? Other guys clear now? How simple is it? It took me 1.5 2 minutes to explain to you. But if you do this concept, it will take you only 30 seconds. I did all the books last night, I sorted out, do the other bits. Are we clear? So you guys have to learn. We've done so many modules and you're still saying you're struggling with calculator. We did a proper 1 hour session, only calculator. Please use this calculator. This is a gift for you guys. It helps you in all the advanced sums and valuations for the exam. Okay. But you have to know the functions. You have to know what the store function is. I know it's difficult when you have to do multiple numbers, but all you have to do is store the numbers and then recall it, right? So what I just do, I recall the first answer. From that, I then remove the second answer and the third answer. This is exactly what I told you about. Going back to my solution, I told you this is the first answer. 50 becomes 51.23. That's the first answer. 0.3 becomes 0.3073 and 0.3 is 0.3. Minus, you will get the solution, which is 50.63. Clear? There's another way to do it, but that's very confusing, so I won't teach you that. The solution here is a more confusing where they said we'll take the cash flows, uska present value aaj ka le lenge, and then we'll minus that and then get the future value. I feel that's too complicated, so we can ignore that. The way I taught you right now is a perfect answer. Take each cash flow and use the calculator and get the answer. So this is the perfect answer, 50.3 into so and so and 0.3. Clear now? Okay. Use the calculator, very critical. Don't take that lightly. Okay. Now, what I was just showing you is the concept of compounding. That's why I did 1 plus r raised to so and so, right? That is compounding. If I do continuous compounding, it will be e raised to r. Okay. So please remember, in the CFA exam, obviously we assume the concept of compounding. If they say continuous compounding, you will have to take the formula as e raised to r. Okay. In FRM exams, normally it's always assumed to be continuous compounding. In CFA level 3 exams, it may come to a bit of continuous compounding. Okay. So look out for those. Okay. 1 year, 2 years, and so on. So fair values, stock e raised to r. So if I tell you what is the future value from 0 to 1, let's say the value of $100 after 1 year, if it's 10%, you'll probably say it's 110, correct? But what you did, you did simple. If I told you to do compounding, you'll say how much compounding? Should it be compounded monthly, bi-monthly, 6 monthly? The answer will change. It'll come 111, 114, and so on. But if I did continuous compounding, the answer will be 100 into e raised to 0.1. This is the maximum value that you can get by using continuous compounding for 1 year. Clear? Okay, so that's how we do continuous compounding. See the formula here? Stock into e raised to r. If you want to find the future value, it is spot into e raised to r. But you do know if you want to find the present value, it'll be spot divided by e raised to r. Correct? And you know the concept, right? If it's future value, it is multiplied. If it's present value, it will be divided. Clear? Okay. And see, so far I've taught you how to find, this is a very interesting rate. I told you that the future value is present value minus cost plus benefits into 1 plus r, correct? Right? Now I could adjust the value here, or I could also adjust this value in the rate. I could do like this, present value and into 1 plus r. Right? Actually, no, it is into e raised to r, right? But in the r, if I want to adjust the cost and the benefit, if the cost and benefit is given in the form of a rate, then I'll adjust it in the rate card. If the cost and benefit is given in dollar terms, I'll adjust it in the present value. Clear? So I'll quickly recap. If I want to find the future value and I have the present value and I have the cost, additional cost and the benefits in dollar terms, this all in dollar terms, then I'll take in the dollar amount and then I'll simply do into e raised to r t, right? This is because these are dollar amounts. But if these are rates, if I have the storage cost in rate terms, insurance cost in rate terms, benefits in rate terms, then the formula becomes present value into e raised to r. But here you will do r plus the cost rate minus the benefit rate and usko into t. Are we clear the two formulas, guys? Take a minute to absorb this knowledge. This is very important knowledge. Okay. Cost increases by dollar amount and decreases by dollar amount benefits. The rate will increase by the percentage cost and decrease by the benefit percentage. Clear? Okay, look at the sum. They're telling you that this index, they want to enter 3 months. So they ask you, give me the 3-month forward contract amount. Simple. Look at the numbers. Spot. Today's rate is 15,200. present value. They're giving you the dividend yield rate, not the dividend yield amount. Yield rate they're giving you. And they're giving you the risk-free rate. So you know that if I give you dividend amount, I would have done spot minus amount. But here's the dividend rate. So I have to do this formula, where the rate is going to deduct from benefit from rate. Is any cost involved? No, in this sum. So what will be the answer? It'll be 15,200 into e raised to, the rate is 4%, the benefit is 2.2%, and the number of the time is 3 months. So it is 3 upon 12. That's your answer. 15,200 into e raised to r minus benefit raised to into 3 by 12. Is it making sense, guys? Please tell me yes or no.
Yes, sir.
Yeah, this is very, very, very important example of a different concept where my rate and cost are. Because the exam, you may be difficult for you to even think, Ari, should I take a rate dollar amount or should I take the rate cost amount? Clear? What's the answer? Solve it on a calci. I want to see if you're comfortable with the calci usage for such a type of sum. Solve that.
So 15,268.55.
What's the answer?
15,268.55.
Brilliant. Spot on. See, now I got the usage. So don't ever get scared of calculating and say, sir, it's difficult, it's tricky. Not at all. See how you got it? Well done. Very well done. Clear? Obviously, remember, if I had given you storage cost, they'll say storage cost or insurance cost is, let's say, 1%. So what will you do? You'll do e raised to 4% plus 1% minus 2.2% और फिर उसको करोगी into 3 by 12. Clear? समझा? So तुझे सिर्फ cost add करना है, benefit minus करना है. Brilliant. Okay. Obviously, I'm saying this, but it is percentage. Huh? So remember, it is decimal. So remember this formula, very critical and something people often miss out. Okay. So the answers 15 to exact answer you got, and learn to get this answers. You have to get the exact answer. Decimals has to be in your calculator. Put it as 4 decimal spots. Kabhi decimals mein 2 is not helpful. Clear? So try to do 4 decimals. Very good. Okay. And this is what you're trying to do. So I made you find out the forward rate. The forward rate after 3 months using the cost. Now, same way you can use it for exchange rate. If you remember, I think economics में क्या था ना, कल ही तो हुआ था ना, interest rate. And I taught you this concept. If you remember, good we're doing right now. Forward rate equal to spot rate. I taught you, remember? I told you into 1 plus R upon 1 plus R. याद है? Do you recall or not?
Yes, sir. Price, currency or base currency.
Yes, very good. And yes, and base and price, correct? और मैंने ये भी बोला कि what to do here, which one to take. So I told you keep it simple. Base price भी जो भूल जाओ. तुम बस यही सोचो कि यहाँ पे कौन सा रेट है. A upon B, whatever is there, call it B. यहाँ पे भी A upon B है, जो भी है, डॉलर, रुपी, पाउंड. But यहाँ का जो A है वो इधर आएगा और यहाँ का जो B आएगा वो इधर आएगा. क्यों? Because spot into. Remember, if it's spot into, then ये इधर आएगा, ये भी इधर आएगा. Simple. Clear? Because this makes a big difference. If you're doing dollar to pound, dollar ऊपर, pound नीचे. If you're doing rupee to euro, rupee ऊपर, euro नीचे. But what is this R? This R is a risk-free rate of that country. Of that country. Clear? So this is called covered interest parity, which I already taught you in economics, and the same formula applies here. Clear? So suppose, and this rate is the no arbitrage forward rate. So suppose the spot rate is 1.1, dollar rate, euro rate. You need to first find out भाई कौन सा rate ऊपर है. Simple. अभी मैं बोल रहा हूँ डॉलर यूरो, तो मतलब स्पॉट डॉलर यूरो है. तो मुझे ऊपर डॉलर लेना है और नीचे यूरो लेना है. सिंपल. sum solved, right? Obviously it's 1.1 into 1.0198, याद रखना decimals है, upon 1.0296. And look out, if it's 1 year, you're okay. If it's 6 months, you'll have to do raise to, जो भी है 0.5, 0.25 and so on, okay? And that's your answer. Okay, like I told you, this is for compounding. अगर continuous compounding बोला तो same formula रहेगा, forward equals spot, right? But this time you will do e raised to the other continuous compounding, e raised to, and you will do RA minus RB, simple. So instead of 1 plus R upon 1 plus R, you will do e raised to R minus R. The first R is A, the second R is B. Got it? Now you will wonder कि भाई कौन सा कब करना है? Don't worry. अगर continuous compounding पूछा है तो ही करो. Otherwise you can do my normal formulas. So continuous is an exception. They will ask you in the exam, do it using continuous compounding. Then बत्ती जलना चाहिए and do e raised to R. अगर silent है, then you can do normal simple compounding. My formula 1 plus R upon 1 plus R. Clear? So remember, continuous is only an exception if they give you instructions. Don't ignore instructions. Clear? So you also learn forward price, the forward rate bhi nikal sakta ho. Forward rate using interest rates, spot rates and so on. Clear? Okay. Obviously the forward rate is higher, it's at a premium. If it's lower, it's at a discount, right? We learned that. So look at this. Forward rate is more than spot. Forward rate less than spot. What do you understand from this? Forward with the domestic risk rate is greater than the foreign risk rate. For fixed. Now let's read this. Let's read each sentence, okay? Ye dekho. Commodity, the convenience yield as a storage insurance cost. Forward where domestic risk rate is high, greater than foreign risk rate. Now tell me this one. Forward is equal to spot into e raised to R. Okay, R. Let's say D minus RF. Okay. Now, when will forward be greater than spot? Because always D upon F. No, we always say D. Forward is spot when D is greater than F, right? So they're saying agar D F se zyada hai, so the answer will be equal to potentially higher forward, right? Here they're saying a commodity which has convenience storage insurance cost. So matlab, agar main forward kar raha hu and I'm doing spot and I'm doing into, right? 1 plus R e raised to R, but I'm also doing plus cost minus convenience yield, correct? So storage भी है, insurance भी है, yield भी है, तो ये सब आ जाएगा. तो forward can be, forward and spot would move, either it'll be higher or be lesser, correct? Because remember, if convenience yield is greater, then the answer might be lesser potentially, right? Forward is greater than spot always if the R is greater, है ना? Because it's forward equal to spot into 1 plus R. अगर R ज़्यादा है, 1 से ज़्यादा है, तो your forward will always be greater. But it is possible that the R could be lesser also. Correct? R negative कैसे हो सकता है? अगर yield ज़्यादा है, right? So in that case, when you have yield, you're going to end up having a lower forward rate. Clear? Look at this one. A fixed coupon bond priced at par and the coupon is above the risk-free rate. Okay. What else? Water for me. You have a fixed coupon bond. So fixed coupon bond means you're getting interest which is fixed, right? And the value is 100. But the coupon is above the risk-free rate. मतलब तुझे cash flows मिल रहे हैं discounting rate से ज़्यादा. Correct? You're getting a higher cash flow which is discounted at a lower rate. So obviously the bond price will be higher potentially. Correct? So now you tell me, take this time and understand, right? See, if the forward is greater, then which answers are working? If the forward is smaller, then which answer will be relevant? I'm trying to find the relationship between फॉरवर्ड प्राइस एंड द स्पॉट प्राइस, लाइक यू भी सेड, अगर फॉरवर्ड स्पॉट से कम है तो मतलब डिस्काउंट पे है, फॉरवर्ड ज्यादा है तो बेस करेंसी प्रीमियम पे है, राइट? बेस मींस द डोमेस्टिक करेंसी. सेम थिंग अप्लाइज फॉर द रेट्स आल्सो. आंसर?
Also, for the forward greater than the spot, it will be the second option, the discounted one.
Very good. Very good.
And for the forward less than the
If
spot,
forward is greater than the spot, that means you rightly said मेरा डोमेस्टिक रेट ज्यादा है, क्योंकि तू समझ गई कि फॉरवर्ड इक्वल टू स्पॉट इनटू ई रेस टू आर डी माइनस आर एफ, ये ज्यादा है तो मतलब ये भी ज्यादा हो गया, ठीक है? वेरी गुड. फॉरवर्ड स्पॉट से कम होगा, कब होगा?
so when the fixed coupon is priced at the par.
Superb. Well done. Well done. Because जो कूपन तुझे मिल रहा है वो ज्यादा है, मतलब आगे जाके तुझे कैश फ्लो ज्यादा मिल रहा है, मतलब प्राइस तो गिरेगा ही ना आगे जाके, करेक्ट? बिकॉज द कूपन इज मोर देन द रिस्क फ्री. इफ द कूपन वाज लेस देन रिस्क फ्री रेट, देन फॉरवर्ड वुड हैव बीन ग्रेटर. वेरी गुड. अभी यहाँ पे ऑब्वियस आंसर इज दिस. टेल मी व्हाई यू थिंक इट्स नॉट इनफ इंफॉर्मेशन. मतलब तुझे नहीं पता चलेगा कि एफ इज मोर और एफ इज लेस, यू कांट फाइंड आउट व्हाई?
So no, क्योंकि your cost और benefit हमें पता नहीं है ना, so one can be greater, one can be less, so depending on that.
Brilliant answer. Brilliant answer. अगर yield ज्यादा है तो forward will be lesser, right? If the yield is lesser than cost, then the forward will be greater. Very good answer. ये tough था. That's why it's a good answer you gave me. This was a good interpretation. ठीक है? This relationship, guys, is very, very, very critical in terms of interpretation. मैं तो बोल रहा हूँ बिना solve करके मुझे interpret करना है तो those questions come in the exam. They try to give you more questions which have interpretative value. They will not see. Remember one thing: CFA is a very practical exam. They will not waste your time and say compute forward rate, because सबको आता है ना, तेरे लाइफ में एक्सेल है, so everyone has a tablet, iPad, everyone will do Excel. So there is no brilliance in computing for me because मेरे पास CFA calculator है. Today the CFA exam is focusing more on the interpretation of the answer, because answer सबको आता है, सबके पास कैलकुलेटर है. They are trying to see ये बंदे के पास interpretation दिमाग है कि नहीं है. So when you rightly said convenience yield and storage cost, if this is more, forward is more, that is what they want to understand. So if convenience yield is greater, then forward will be at a discount. ये समझना important है. Understood? If the convenience yield is obviously lesser, cost is higher, your forward price will be higher. Okay, very good. And focus your direction on these learnings. Correct, that's the right answer. You covered it in that. Okay, fantastic. So with that, we covered a lot of critical concepts. Some of them are very high level also. Please remember this and don't try to ratify them. Don't try to say, मैं ये वाला mug up कर दूंगा. Trust me, कल तक भी याद नहीं रहेगा. तुझे रिलेशनशिप इंटरप्रिटेशन सीखना पड़ेगा कि भाई क्यों फॉरवर्ड ज्यादा है, क्योंकि तेरा रेट ज्यादा है. फॉरवर्ड क्यों डिस्काउंट पे है, क्योंकि तेरा जो रेट है जिससे तुम ऊपर आरडी माइनस आरएफ करोगे, अगर आरडी बड़ा है तो ऑब्वियसली एफ ज्यादा ही रहेगा, तो अगर आरडी कम है तो एफ तो कम ही हो जाएगा ना. सो अंडरस्टैंड द रिलेशनशिप एंड द कनेक्शन. ओके ओके, चलो ठीक है. थैंक्स, बाय, टेक केयर.